But you could have argued that it was the flip recently, that the market got ahead of the Fed. So that kind of sequencing is interesting. Equities this morning, keep an eye on Daimler Trucks, keep an eye on what is happening with ITV this morning. We're going to talk to Valeo a little bit later on in the show, so we'll talk car parts as well. Equity markets, though, as I say, probably not as much driven by what we've seen in terms of the single stock narrative this morning. You are likely to see a little bit of a pickup at the get-go. It'll be interesting to see how quickly that kind of initial momentum fades. So here we go. Stocks open for the Friday session. Remember, it's also the first day of a new month, so there's probably a little bit of repositioning, which we've seen kind of back end of the month of February into March. We'll see how March kind of starts off. But initially, positive.
Okay, if normative determinism plays any role, as you said, with the leap day yesterday.
Way too early for things like that.
the leap day yesterday, well, now we're into spring by some measures, aren't we? So maybe we spring forward
higher
today. Springing higher on markets.
You're just on a roll this morning, aren't you, with the puns. I think your point about whether or not this kind of catch-up trade is showing up, it's going to show up today. We're already seeing the FTSE 100 higher by 0.6%, but the repositioning story likely to happen on Monday because of today's catch-up trade.
Yeah, I think there was probably. So yesterday's US session I thought was interesting in as much as there was likely to be a bid into equities versus bonds, just the reposition. I think there was some evidence of that yesterday, though I still think it was a kind of short-term positioning story.
Yeah.
That probably had a big
around
effect.
The data.
Yeah. Looking at the sector breakdown this morning then, and everything is springing to the green this morning. Technology is the best performing sector, up pretty strongly there. Of course, Nvidia and others in the tech space benefited yesterday from that move higher in stocks, and we see a mixed bag of tech names moving higher. There's nothing on the downside. Healthcare, financial services, sure, they're the least positive, but nothing on the downside today.
We're going to talk to Valeo a little bit later on. Valeo, I'm never quite sure how I should be pronouncing that, but that stock looks like it's having a very big pop this morning. Potential for upgrade seems to be the analyst's conclusion on what we're hearing there. Be interested to get the EV trade story as well. We are seeing some of the luxury names coming under a little bit of pressure, but tech is having a good morning. Look at ASML, the benchmark for European tech, up by 1.21%, the leading weight gainer in terms of the upside, but SAP's also having a fairly solid morning. I was talking to Citi yesterday, Beata Manthi, and she was talking through her Super 7. ASML's in there, SAP's in there, Novo Nordisk is in there as well.
Is this their answer to the granolas?
So it is their answer to the granolas. They think the granolas are too defensive. They think these are the stocks that are ultimately going to lead. It's more of an answer to the kind of Magnificent 7. It's the Super 7 over here. Is Super better than Magnificent? I don't know.
I think Magnificent still
wins.
Sounds grander.
It does sound
and granolas.
grander.
I think granolas is a weird name anyway because it sounds quite worthy.
Sounds very healthy for you.
A little crunchy, if you will. The downside movers, though, on the one hand, even though in the FTSE you are seeing, I think, only 6 stocks that are on the low side. Standard Chartered seeing some heavy volume there, but on the stock 600, there's a little bit of a shipping theme. It seems like Maersk. Sorry.
Yeah, AP Maersk is down.
Yeah, Maersk is down a little bit. DHL is down as well, and those are some of the biggest.
Presumably that's the Kuehne+Nagel read.
Yeah, because this was about shipping rates. Yeah, that was the area of disappointment there.
Which isn't open yet, by the way. So we'll wait and we'll get a trade on that very soon. Let's go back to the macro story. It feels like that kind of is the dominant theme once again this morning. David Weston had a fantastic interview yesterday with Mary Daly from San Francisco. This is what she had to say about kind of the rate narrative.
We want to avoid holding on all the way to 2%. They're putting policy very tight and then cause an unnecessary downturn. We are agile, and we're sitting in what I call the ready position. We are ready to make moves and adjust as the data demand us to do. And I think right now the economy and policy are in a good place to do that.
Mabruk Chetouin, head of global market strategy at Natixis Investment Management, joins us now. Mabruk, the sense seems to be that the US economy is in a great place right now, and that's going to continue to drive stocks. How long does that narrative last? Is there anything that upsets it at the moment?
Hello. Yes, the US is clearly the place to be in terms of investment, in terms of growth. It could continue to be the case over the first half of the year. I mean, until the end of June. I mean, clearly we do not expect any significant change in terms of growth. Growth is pretty resilient, and it is explained by a solid labor market. Again, the same story is clearly taking place in the US this first half of the year, over the first half of the year. In the second half of the year, for the H2, clearly we can expect some signs of decline of the business cycle, because I mean the level of interest rates are clearly now could have a negative impact on the business cycle and the activity. But so far, I mean, there is nothing that could hit the US economy, in our opinion. Growth is extremely solid, and it will continue to take place to be the case over the first half of the year. And clearly, this is not the moment for the Fed to do anything. I mean, the best position for the Fed is to wait and to see what the data are telling. And I'm pretty sure that the data will confirm this.
So, Mabruk, do you just keep buying US stocks? Is that the trade?
Yeah. I mean, if we look at the data over the history, I mean, we have to take. I mean, there are two lessons. Don't fight, I mean, any central banks, especially the Fed, and don't fight the trend. It's pretty, I mean, it's not, I mean, efficient for asset allocators to be against the trend. I mean, the trend is so, I mean, the strength of the trend is so powerful, I should say, that, I mean, to be against this one, this trend is clearly not the right decision to make in the portfolios. So clearly we do prefer, I mean, all the growth bias, I mean, all the indices that are exposed to this growth bias and to this tech bias. So because, again, this is the promise of solid earnings in the future.
So, yeah, so the tech bias, how much do you buy that then, Mabruk, because you really believe that this is a step change in productivity and the ability of this technology to deliver is going to be really material, and therefore higher ratings are justified? Or how much are you just, following that trend and don't want to miss out on that upside?
Well, in the war, I mean, compared to a benchmark, I mean, we have decided to play this trend since, I mean, last year, I mean, the middle of last year, and we are playing this trend, I mean, using, of course, some indices in the US stocks, Japanese stocks, because they have all this tech story in their indices. And we have, I mean, an overexposure to the US economy about, I mean, between 5 and 10%, clearly. So this is, I mean, a massive conviction that we have within Natixis, that this is clearly something that we can miss and we can, be exposed to. So a massive, I mean, overexposure to the US equity and to this tech bias is, in our opinion, absolutely key for allocators and for the performance of our portfolios.
Okay, and Mabruk, how much, you talked about not standing in the way of a trend, and you're certainly citing that when it comes to the US tech theme. What about Japanese stocks? I know that's another trend you don't want to stand in the way of and you want to benefit from. Is that at risk if the BOJ does step away from negative interest rates, if it pushes the yen higher, if exporters do less well as a result? Is it at risk, that Japanese stocks trend, or is it much more structural and long-term than that?
I do believe that this is a more structural story than a risk for the economy and for the Japanese stocks. I mean, we have to bear in mind that this situation of negative interest rates is not, I mean, usual. It's not normal, actually. And if the BOJ, for example, is deciding that they have to leave, it's the right moment to leave, and this negative interest rates, it's a good signal sent to the market that the situation has, I mean, normalized. And Japan is now, I mean, rediscovering, I mean, inflationary pressures, which is a very, very good point for, I mean, again, for the corporates. It's very complicated to defend margins when you are in a deflationary environment. When the situation is, when the economy is exposed to deflationary pressures, clearly this is the worst case scenario for an economy and for the stock markets as well. So now, I mean, we have these inflationary pressures. We have a step-by-step approach of the BOJ clearly, and they will not, I mean, break this positive trend. And again, we have the same story in Japanese stocks. We have this fantastic, I mean, tech companies that are, I mean, following this trend and participating to this tech and AI story.
Brooke, talk to us a little bit about the liquidity piece of this equation. How much of the rally that we're seeing globally is due to liquidity?
Well, clearly now, what we do see is that investors and allocators, they are clearly leaving, I mean, the bond market, because now, I mean, the bond market has there is nothing to expect from this market. So they have amount of money a large amount of money to invest, and there is this fear of missing out, clearly, that fitting the equity market. On the liquidity side per se, what we can see is that there is no, I mean, massive issue on the liquidity. Liquidity is, I mean, clearly here, and the problem is that this liquidity is concentrated on large stocks, of course, large indices, not on the small one, and the small indices, the small cap, for example, are suffering from this lack of liquidity. And this is something that we need to monitor in order to make the right decision in the portfolios. But so far, I mean, there is no issue on this front, despite, I mean, all the monetary policy environment and so on. So clearly, and so far, no issue and no clear signal, no threat on the liquidity from the beginning of the year.
So that's liquidity from a market's perspective. Let's talk about liquidity from an individual company's perspective. The tech trade in the last couple of years has largely been driven by the record amounts of cash that you've seen, not just on their balance sheets, but on even S&P 500 corporate balance sheets, a lot of that coming from record issuance as well. Is there a liquidity trade here in terms of vouching for or investing in stocks or companies that have more cash on their balance sheet?
Well, there is, I mean, on the liquidity, if we took the liquidity on this angle of attack, what we can say is that liquidity is clearly a positive signal that these companies, these tech companies, are sending. I mean, they can use this cash, this liquidity to fill the buyback and supporting again their prices. I mean, their equity prices and their stocks. I mean, these large amount of cash used, existing in the balance sheet of the companies are clearly something that could be used, in different ways and could, support definitely, the equity market. So this is not, I think this is a very positive signal. And to be honest, I'm not, this is more corporate finance, and this is not my specialty. I have to admit, I have to recognize this. But so far, there is, again, positive signals sent by this liquidity indicators.
Chetan, we'll leave it there. Thank you. Sorry, Mabruk, we'll leave it there. Sorry, my bad. Mabruk, thank you very much indeed. Mabruk Chetan, head of global market strategy at Natixis Investment Management. Thank you very much indeed. In terms of what we're seeing with the equity market this morning, tech up, insurance down, healthcare is a little softer as well, but technology, to your point, Anna, just kind of leading off what we saw in the States yesterday.
Yeah, absolutely. It does feel as if that is part of the catch-up trade, doesn't it? Really interesting to see that, Kuhn and Nagel does seem to have had an impact on the sector. There is a bit of nervousness about what those rates do. To your point, the Red Sea is devastating, as a lot of the news flow is day after day in that region. The Red Sea story from a corporate perspective, perhaps fading a little bit in terms of the high fees they have to pay to use those logistics providers.
I think freight rates have come down a little bit, but I think we're just getting used to that narrative. The market moves on from a narrative very, very quickly. This is now becoming normal. You don't go through the Red Sea, you go around the long way. So the market is adapting to that and will continue to adapt. But at the beginning of the reporting season, we heard company after company addressing this as a potential inflationary impact. Central bankers have been talking about it as well. And
we might actually still see that. I still think in the next quarter, you're going to have a little bit more numbers, a little bit more context around it, because the assumption was this was going to last a few weeks. It's now been months, and it doesn't look like it's going to stop at any other point. Another stock I want to put on your radar, Ørsted, moving, one of their biggest actually index contributors here to the stock 600, is coming off some contracts awarded out of New York to Equinor and Ørsted as well on wind farms in the Atlantic Ocean. I did not know you could build wind farms in the Atlantic Ocean, but apparently you can.
Right. Well, there's certainly a big push towards investing in the climate transition in the US and fiscal policy never far from that. So that's certainly something that we've talked about and will continue to watch. Coming up on the programme, we will get back to the macro stories, euro area inflation. We're going to look ahead to that data. It's coming out later on this morning. We'll get a briefing. We'll also digest today's news from the Swiss National Bank, from the SNB. Thomas Jordan stepping down there from September. We will look back over, well, January 2015 springs to mind when we think about Thomas Jordan. We'll get back to that conversation. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Why should somebody want to be in the pharmaceutical industry? Why not go into something sexy like private equity?
In the end, what we do is we create these miracles that fit in the palm of your hand, these little medicines that can transform a human being's life.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a huge week ahead in politics. On March 5th, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, 2 days later, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kaylee Lyons, and Bloomberg's top political analysts will bring you live global coverage of both events, starting Tuesday, March 5th. Bloomberg. Context changes everything.
This is Marcus Today. We're about 17 minutes into the European trading day. Seeing some green on the screen here. Outperformance in the FTSE 100 higher by 0.6%. The Euro Stoxx at 600, higher by 0.4%. What you need to know is that it is a fairly broad rally. There aren't that many red or companies in the red. There are some downside movers. We are going to dive you into that in just a few minutes. But first, let's bring you some breaking headlines. This time coming out of Spain. Their February manufacturing PMI rising to 51.5. The forecast was 49.8. So a little bit of an expansion there. At right off the heels, by the way, of some hot CPI data that we had gotten from Spain as well. Jamie Rush, our chief European economist, said it might just be a leading indicator, even though from a broader Eurozone perspective, we don't often look at Spain.
Yeah, really interesting to see Spain doing so as well as it is, back in growth territory, of course, above 50. We'll get further analysis from our colleague Zoe Schneeweiss in just a moment, but it does seem as if Southern Europe telling a different story, a better story than the North right now. Let's get a check on some of the individual stocks that are on the move this morning. Lizzie Burden here to join the dots between the macro themes and the micro. Lizzie, what have you got this morning?
Yeah, thanks, Anna. Well, we kick off with the UK home builders because we did have Nationwide's latest report on the UK housing market this morning. Actually, for the first time in 13 months, house prices grew year on year. You're seeing these lower mortgage rates luring people back to market, and that's boosting the home builders this morning. Taylor Wimpey, 0.7% higher this morning, as are Barratt and Barclay as well. If we look at some of the other stocks driving the gains this morning, because as you say, Critty, it's green across the screen for European equities this morning. The sector that's leading the gains is autos, and if you take a look at why, some of the biggest movers include Daimler Truck. I mentioned its earnings earlier. It is a bit of a barometer for the macro picture in its key markets, North America and Europe. Yes, you've got the recession risk flagged in those markets. However, analysts have said that everything was better than expected in this report, and it's a bit happier about the year ahead than its peers. You're also seeing gains for Valeo here, higher 3% almost this morning. This, of course, is also a maker of auto parts. Also had its results out this morning ahead of expectations, and even if it cut its 2025 targets, it's pretty much mirroring what its peers are doing anyway. SocGen's raised that stock to buy. If we have a look at Saint-Gobain, one of the losers this morning, this is the French maker of construction materials, lower 2% more than this morning. It's having to cut costs to deal with pricing pressures in the construction industry, and even if the results came broadly in line with expectations and you had that share buyback announced, a hit to the stock this morning. Kuehne + Nagel, lastly, the biggest loser on the stock 600 this morning. It's seeing pressure on its freight business in the sea freight side because of all the turmoil in the Red Sea. It did announce the acquisition of City Zone Express on the road freight side, but that's not doing anything to lift the shares. 10.6% lower this morning.
Lizzie, great stuff. Thank you very much indeed. We'll come back to that housing story a little bit later on. February. Who'd have thought it? Buying houses in February. Let's talk about what is happening over in Switzerland. The Swiss National Bank President, Thomas Jordan, is stepping down. He will be doing so in September. He's been around for a while. He's been in that job for more than a decade, and it's been something of a bumpy ride. I think that probably is something of an understatement. Joining us now for more is Bloomberg's Zoe Schneeweiss, who leads Bloomberg's Western European economic coverage. Why is he going? Who's going to replace him? How big a shift are we likely to see at the SNB?
So overall, this isn't really it is a surprising move, but not completely unprecedented. The way it works with the SNB is that presidents have don't have any term limits. So always when they're nearing 65, the retirement age, they then will announce they're stepping down. This maybe is a tad earlier than expected, but still, it's one of those things. Thomas Jordan is the longest-serving SNB president in the institution's history, which goes for over a century. So the typical situation here is that his successor, that the deputy would be his successor, that the vice president. In this case, that's Martin Schlegel. Martin Schlegel is still in his 50s. Jordan is in his 60s. Schlegel only has been on the governing board for less than 2 years, and the third person on the governing board, Antoine Martin, just started in January. So that means that this would be really be a rejuvenation of that board. There also, of course, is the option for the government to opt for someone completely different. We just had the number 3 in the SNB leave for the BIS. That's Andrea Mechler. Obviously, appointing a woman would be of huge significance in Switzerland, where we know women typically do not reach top echelons. So there's a lot of options here. It's an exciting situation. I lived in Switzerland myself for 6 years. I was there when Thomas Jordan got rid of the cap on the franc in January 2015. So this really is quite a seismic move that he's announced his departure in September today.
Yeah, curious, of course, to see what the policy implications of that look like. And Zoe, stick with us. We should mention very quickly that we actually will have Thomas Jordan joining Bloomberg Television later this afternoon. Be sure to tune in for that interview. We'll, of course, bring you the latest on kind of what was the thinking behind the move and what the next steps for the S&B might actually look like. In the meantime, Zoe, talk to us a little bit about the euro area inflation we're going to get later today. We already got some numbers out of Spain. Is Spain potentially a canary in the coal mine for the rest of Europe?
Yes, we had Spain, France, and Germany even yesterday. All those numbers ticked down. That overall fits the picture of what's happening on euro area inflation. Euro area inflation, remember, in January was at 2.8%. Economists predict that it will be at 2.5% now for February. That is obviously the right direction. This inflation is happening in the euro area, but it does mean that it's still far from that 2% which the ECB is going for, which means that if the ECB wants to follow its narrative of cutting rates in June, the number today of 2.5 would fit that narrative exactly.
Zoe, thanks very much. Bloomberg Zoe Schneeweiss with the latest on the SMB and some of the other macro themes around Europe. Thank you very much for that. Let's turn to the UK story right now. Sophia Horta-Acosta joins us from the Markets Today blog, and we can go through some of the driving forces behind the UK market right now. Good morning to you, Sophia. I want to pick up on something Guy was referencing, the surprise that people are buying houses in February, especially when February has been extremely wet. It certainly hasn't made me go out and buy anything. And that is reflected in the retail traffic data, actually. So we have people not going to the shops, train strikes, squeezed budgets, wet weather, but they are buying houses. How does that make sense, Sophia?
So it does. I mean, the macro environment going into this year, especially in December when the market really reassessed the outlook for interest rate cuts from the BOE this year, you saw the impact on the mortgage market, and nationwide saying that house prices actually rose 0.7% in February. That's more than twice the pace that economists had predicted. One really important figure that we're highlighting on the blog today is actually prices are only 3% below the record in 2022. That's a very small dip, especially given a lot of people were predicting double-digit declines last year. But yes, nobody's going out to, I mean, Anna, I think a lot of people did what you did in February, just stayed in, had a cozy cup of chocolate, a hot chocolate, and, you know, wet weather. But
bought a house.
And bought a house. Wet weather strikes, also the end of the sales season, perhaps. People just not hitting the high street. I think the high street, the UK high street and the UK housing market are very different stories.
Wet weather, good monopoly weather, is all I will say. There's been a bit of that in our house. So maybe some house buying, maybe even a few hotels.
There we go.
UK consumers have not been spending money. Are they going to spend their money on stocks? Jeremy Hunt wants them to.
Jeremy Hunt definitely wants them to. That's kind of the pitch. Get retail investors investing in the domestic market. It's a very hard sell. You and I, Guy, have talked about this before. You know, how do you get retail investors to invest in an underperforming market? One way to do this is to launch the British ISA, but there's expectation that actually that would be tax efficient for UK stocks and not tax efficient for international stocks. I expect there to be a backlash if that does happen. And one thing that's happening, I mean, valuations are incredibly low in the UK. That's not an exciting market. You know, that's not what, people are not chasing cheap, they're chasing growth.
Yep. And I wonder whether a more effective way would be to maybe get rid of stamp duty, but that's a debate for another day. Sophia, thank you very much indeed. Sophia Horta-Acosta from our Markets Today blog. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. And so he's on the bus
after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year, and so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
This is Markets Today. We're 30 minutes into your European trading day. Quick look at the markets, and we're up by 0.6% on the FTSE. The CAC 40 is pretty flat this morning, up by 0.6 in Germany. So a little bit of a disconnect across the European space, up 0.3% overall. We've actually had a changing of the guards in terms of the sector breakdown this morning. Tech was at the top, playing catch up with the States yesterday. Now tech dropping down the leaderboard, and actually autos and parts to the fore. And that's interesting because we're going to be speaking to the Valeo CEO shortly, and that business is one of the gainers in that autos and parts space. Construction materials, that's the lagging sector, that one down by 0.4%. So continue to see gains. Interesting that US futures still pointing higher, not quite as much as they were, but NASDAQ futures quickly up by 0.3%.
Up 0.3%. We're talking about, was that a catch-up trade today? Are we going to really see more volatility going into next week when we have kind of the ECB? We've got Super Tuesday. We've got the budget next week. There's so much happening.
Payrolls.
Second
Friday of the month.
Yes, tomorrow. I guess we can't call out sick all of next week.
No,
what I'm getting. I'm not allowed. No. I'm not allowed. But for me, I mean, I'm putting my American hat on. It's about Super Tuesday for me. I'm curious about how it's all going to play out and what that actually looks like in terms of the read-through. This is a market that isn't pricing a Trump versus Biden show-off, even though that's largely the expectation.
Yeah, we'll get into that conversation in a moment. There is still that chance that maybe the China story catches us off guard instead, although even Mark, who's always focused on things Asia, of course, he was telling us earlier, can tend to stay in Asia at this point. But if they surprise us with a growth target that is higher than expected or more support than had been anticipated, you could see some European stock reaction.
Yeah, the kind of the obvious proxy trade would be what's happening in the luxury sector. Be interesting to see what the read across there is that they try and stimulate the consumer in the States. Payrolls on Friday, though, again, could be interesting. It was interesting that there was sort of slightly soggy claims number yesterday, slight tick up in the States. Payrolls on Friday, again, we come back to this labour market, what's happening with wages, what's happening with the consumer. That could be one of the really interesting tales on what the narrative looks like.
And on the ECB, really interesting to factor in this slightly stronger data coming out of Southern Europe. Yesterday, the Spanish inflation print coming in a little hotter, and then the PMI number coming in a little hotter this morning, really adding to that narrative about a two-track Europe. It's not the two-track Europe we were used to in 2011, that's for sure. It's a reversed two-track Europe, and the South doing pretty well.
But that might actually be a positive, right? Hasn't the South always been kind of the Achilles heel of Europe, famously? But perhaps this is a sign of strength as opposed to a sign of weakness.
I still find it ironic that it's the core central bankers let's call them core central bankers that are calling for no rate cuts, and it's the peripheral economies that are calling for rate cuts, despite the fact that actually in the economic story, it is exactly reversed.
Yeah, Freya was saying that the ECB still listening to the Bundesbank and channeling their experience over the last 50 years, and in her view, becoming very tardy as a result.
Tardy.
Yes, exactly her word. I wrote it down.
We didn't even talk about the UK budget and the implications there as well.
I might throw that at the end of our next conversation.
We'll cover it all, of course, in the next couple of minutes, but also all of next week, so be sure to tune in. In the meantime, we're going to come full circle right back to the U.S. story. What are the implications of the U.S. presidential election, specifically on Europe? Some people say there's big ones. Others say not so much. Take a listen to the take out of J.P. Morgan and Trafigura.
When tariffs are imposed, say by the U.S. on other countries, we saw this with China, the currency of that country will weaken to offset the competitive disadvantage it puts it at. And that weakening, if it's 10% tariffs, is about 50 to 60% of that tariff, so about 5 or 6% strengthening in the dollar if 10% tariffs are imposed. If tariffs are a serious policy option here, it's really going to, firstly, prevent the market from engaging in any kind of dollar weakness in response to the growth pickup we've had, because it's gonna take off growth.
Honestly, I don't think it really matters that much who is in the White House. So shareholders saying, actually, we want you to prioritize buybacks and dividends over new capital investment. I want dollars, not barrels, right? And if that's the case, then it's not really a question of who's in the White House.
All right, so some mixed views there. Let's speak to Lizzie Galbraith, adding one more view, the political economist over at Aberdeen. Lizzie, a pleasure to have you on the program this morning. There's some mixed thoughts about what the implications specifically for Europe, specifically for the markets, might actually be. Walk us through your take. What is your biggest risk that you're viewing out of the United States?
I think, broadly speaking, we're seeing Biden represent sort of continuity in the US-EU relationship, whereas Trump does pose potentially some bigger risks. And for Europe, that's probably twofold. One, you probably have a bigger risk that there is a substantial change to the defense commitments that the US holds with Europe, so particularly around things like playing an active role in NATO and support for Ukraine. The other is around this tariffs point. So Trump has proposed a 10% baseline tariff on all US imports, but we also know that in his first term he did other things as well. So the steel and aluminium tariffs did affect Europe. He also at some point thought about introducing additional tariffs on autos as well. So there are other potential risks, even if Trump doesn't go down the route of introducing a universal tariff that are worth keeping an eye on.
Lizzie, what does the reciprocity of that actually look like? It feels like every time this is indicated that President Trump or even President Biden, who's kept a lot of the tariffs in place during his presidency, what does the European response look like?
I mean, last time we saw Europe try a slightly asymmetric approach where they did increase tariffs on some goods, but they weren't, like for like. So introducing tariffs on very popular consumer items that were sort of popular in the US markets, for example, to try and really emphasize to US consumers that there are negative implications of this sort of tariff-based approach to trade. We didn't really see that have a particularly big impact on the way Trump thought about tariffs in his first term. So would I expect some reciprocity? Yes. Would I imagine it would be enough to fundamentally alter Trump's approach? No. We do see him take quite a transactional approach to trade on occasion. So I think he will be looking for concessions to be made in exchange for altering or lowering tariffs, rather than trying Europe necessarily getting what it wants through increasing its own tariffs.
Lizzie, I'm trying to make this more stock specific in terms of the impact that we could be looking at. Do you think it would be, once again, the luxury sector that maybe falls under the spotlight? Do I need to be thinking about LVMH or some of the spirits companies that could come under pressure? You talk about the defense story. Would Europe increase defense spending? Would I be buying European defense stocks on the back of a Trump win? Can you just be a bit more granular in terms of where you think the thinking is right now? Or do we just simply not know what would happen and which sectors could be targeted?
I think it's very difficult to know. I mean, Trump is an incredibly unpredictable politician. That's one of the big risks with his style of leadership, that you just don't quite know until he actually commits to a policy. But we do have indications from his first term, and I think that does offer a good baseline. So I think Europe's response could well be fairly similar in that they may choose to look at things like the luxury sector again. Equally, Trump may also focus on areas that he did in his first term. So I would say that a return of the steel tariffs, for example, would be an obvious place to look. But I think on defence, it's actually quite difficult to see a real response sort of brewing from on the European side. They've been talking about raising defence budgets really since the invasion of Ukraine, and we've seen that actually be very slow to really actually turn into any meaningful change. So they may want to do this, they may want to insulate against the risk, but actually turning that into reality in an era of far more constrained fiscal landscapes across Europe is really quite difficult.
Lizzie, what would Biden's industrial policy look like if he were to get a second term? Would we see something akin to the Inflation Reduction Act? Industrial policy in the States has changed significantly. You could argue significantly to the detriment of Europe, and has driven the US economy. And I'm wondering whether or not that policy just simply continues, and that kind of America First industrial policy continues to disadvantage Europe.
I think we definitely see Biden want to protect the Inflation Reduction Act as much as possible. One thing that we are expecting from this US election is that we think it is extremely likely that the Republicans retake the Senate. And in that environment, even if Biden were to retain the presidency, it would be very difficult for him to extend his industrial policy in any significant way. But he would certainly try and protect what's there from cuts as much as possible. And we'd also see Biden continue to try and go further with his friendshoring agenda, for example, in critical minerals. But I think we would still probably see Europe struggle to, for example, get a critical minerals deal with the US that would help lessen the impact of the Inflation Reduction Act for European autos. We've not seen too much progress in that area in Biden's first term, and it's not clear that would change in a second.
Yeah. Yeah, it does seem as if there is some disappointment in European political circles around what's been achieved under a Biden administration, Lizzie, but fear for the future, perhaps. In terms of the US election and how it rubs up against other political events, thinking here in the UK, of course, about the UK election, there does seem to be quite a lot of thought being given to the timing of these two things, because if they were to fall quite close to each other, we've had some reporting that suggests there are some security bodies that are concerned about these two political groups taking their eye off the international stage. Lizzie, what are you hearing on that front?
So our expectation is still that the UK election is most likely to be called in late October to mid-November, and that does obviously put it extremely close to the US election on the 5th of November. The security angle is obviously a concern, and that does mean that an election in May coinciding with the local elections is still very much on the table. But our understanding is that isn't the preferred option, primarily because of the significant polling deficit that we see the Conservative government facing at the moment, and they would like as much time as possible to try and close that gap. It doesn't change our outlook for the election outcome itself. We're still expecting a Labour majority government at the end of this. But yes, it is. I think the security issue is a factor, but not necessarily the defining one.
Yeah, Lizzie, given that the outlook does seem, well, the polls certainly suggest that the Labour Party could get a substantial majority when the election comes around. I was drawn to one of the lines in your notes because I was thinking, well, if that's the case, how much do we focus on the budget in the UK next week? Maybe the markets have plenty of other things to think about, that's for sure. But then you said in your notes today that if we see next week tax cuts funded with further spending cuts towards the end of the forecast horizon, then that risks creating credibility concerns. And in the UK context, given what we've seen in the last couple of years, that sounds risky. How much of a risk is that?
So I think it is significantly smaller than anything that we saw in the aftermath of the Truss mini budget. I'm not suggesting that it would be in any way on that scale. The government has certainly learned a lot from that episode. But I think there are still we saw a lot of criticism in the autumn statement when the government did this, when they funded the tax cuts that we saw then with some fairly unclear but quite substantial spending cuts at the end of the forecast horizon. Now, that generated quite a lot of criticism at the time. And I think if that were to be repeated again, then that just compounds the issue further, and it creates even more questions over the viability and the sustainability of this approach to budgets. And it's something that is a problem now for this government, but it's also a problem that the next government will inherit, because they will have to deal with these forecasts, and they will have to attempt to, introduce the policies that they want to in a very, very constrained future fiscal environment.
A tough situation on both sides of the Atlantic. Lizzie Galbraith, political economist over at Aberdeen, we thank you so much for joining the program. And actually, started off the interview by saying it's a very busy week. Of course, we're going to have the UK budget next week. We're also going to have plenty in U.S. politics as well. We're going to bring you special coverage of Super Tuesday and President Biden's State of the Union address on Thursday, right here on Bloomberg Television.
Okay, coming up, we go to the auto parts sector. Valeo shares jumping after the French car parts maker reports earnings and outlook. We'll speak to the CEO. That conversation coming up next. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
I'm a conservative, but I'm not in a bad mood about it. Fellow
governors. Bad mood about being conservative? Is that because you feel like populism has taken control of your party?
And Joe Matthew.
What is it about race that bothers you about the new chairman of the Joint Chiefs?
Our military is becoming so political that we're going to go south when it comes to readiness.
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
we love everybody who makes cars, right? We try to serve really everybody who makes cars. And obviously we are monitoring very carefully what's not happening, because in the end, the consumer decides. And the consumer is influenced by many things right now. It's influenced by the interest rates, it's influenced by the general economic mood, and by emotions, because you're not buying as a consumer for a reason that you need to buy something. You're buying because you want to buy something.
That was the CEO of Bosch, Stefan Hartung, speaking to Olli Krug in Germany. Let's stay in the sector. Valeo shares initially popping sharply higher this morning. That move has now subsequently faded. We're basically back to flat for where we were yesterday. Take a look at the two-day chart in your Bloomberg and you'll see that very clearly. The French car parts maker reporting results and guidance that was certainly ahead of expectations, though. Let's bring in the Valeo CEO, Christophe Perillo. He joins us from Paris. Thank you very much indeed, Christophe. Nice to see you this morning. The outlook seems to have captured everybody's attention this morning, despite the fact we are seeing the stock fading. The outlook seems to be maybe driving an expectation that we're going to see some upgrades in terms of your stock price performance. Why are we seeing that more rosy outlook, that better outlook? Is it because your longer-term plan is delivering, or is it because the operating environment is getting better?
Well, I think we're making progress. The company is making progress. You know, 23 is an important year because it's halfway through our strategic plan. And our strategic plan was really about, you know, point number one, positioning Valeo on the trends, the mega trends of the industry. And we made, in the last 2 years, extremely clear choices. It's about electrification, it's about advanced driving assistance, and it's about software. And it's paying off. You know, looking at our release of yesterday, we said that we could secure in 22 and 23, 70 billion euros of new orders from our customers. This is 2 times our sales. So that shows that the technologies that we have, the products that we have are, you know, exactly what the market needs. And now in terms of profitability, what was extremely important is, you know, to go through step-by-step improvement. We could achieve our guidance in 22. We could achieve all elements of our guidance in 23. And we disclosed yesterday guidance for 24, guidance in 25, showing step-by-step improvement.
Okay, so that's the improvement that you anticipate and you hope for. Christophe, good morning. Obviously a lot, and you mentioned electrification. Obviously your sector very much focused on that transition right now. We have seen a bit of a slowdown in the EV space. What's your expectation for how that plays out?
Well, you know, everybody talks about, you know, EV slowdown. When you look at 23 numbers, the market has increased 30% when it comes to the number of EV cars. So the growth is still extremely spectacular. We know the endpoint. The endpoint is that the car is going to be electric. We know as well that, you know, the road to this endpoint will be potentially bumpy, but it's not changing the endpoint. So we are continuing, as far as Valeo is concerned, to focus, you know, our research, our development in bringing good solutions, good systems for the EV, and to make the EV more affordable, which is extremely important. And that's what, you know, a company like Valeo is doing on a daily basis, optimizing, reducing the cost, improving the performance, so that the EV gets better and the EV gets cheaper.
Thinking about these low-emission powertrains then, we heard from the Renault CEO recently, back at the Geneva Auto Show, I think, talking about how a supplier could maybe become part of their Horse joint venture. That's a joint venture on these kind of powertrains with Geely and with Saudi Aramco. Would you be interested in joining that kind of JV?
Well, no, I don't think it's, you know, on the agenda. But what is the agenda? On the agenda is ready to work as partners with our customers. And you mentioned Luc Ademio, you mentioned Renault. Actually, we have an extremely important project together, Renault and Valeo, to co-develop, to co-design, and to co-produce the future electric motor of EV cars, which will be the best motor ever in the industry, more affordable and more performant. So it's not in the form of a joint venture, but it's in the form of, you know, a partnership, a co-design, and a co-production.
Christoph, Creedy in London, talk to us a little bit about kind of the lower cost piece of the equation you were just talking about in terms of cutting jobs, in terms of cost efficiency, even in terms of facing any sort of risk from the Red Sea and the implications on your supply chain. What does that look like?
Well, we're not really seeing any disruption from the Red Sea. You know, the ships are taking 2 weeks more to get from China to Europe. And, you know, this is just now in the planning. This is, you know, taking into account by our supply chain teams. You know, the supply chain teams have been extremely resilient over the last years. They've been crisis after crisis after crisis. Probably the most severe of them was the electronic shortages, you remember, 21. So we're not seeing any disruption from the Red Sea events, actually.
Are you seeing pressure, though, from car manufacturers, for example, to push those costs lower? What does that relationship look like?
Well, you know, looking into 23, we could mitigate the impact of inflation. And we did that, on the one hand, talking to our customers and trying to find the right prices, and on the other hand, by reducing our costs. So it's always about price and cost. Our results in 23 that are better than what they were a year ago is showing that we could mitigate, you know, the impact of inflation. And going forward, looking forward, we're going to apply exactly the same recipe. We have discussions on prices with our customers because there are still some inflation, especially on labor, but we are as well having some self-help measures, some cost reduction programs in order to mitigate, at the end of the day, the impact of inflation.
Christoph, great to see you this morning. Thank you very much indeed for spending some time with us here on Bloomberg. The Valeo CEO, Christoph Perrelot, joining us on the numbers which came out yesterday. Initial bounce in the stock, that's beginning to fade. More conversations coming up, plenty more great CEOs that we're going to be talking to get a sort of temperature take on what is happening with the global economy. The CEO of building materials maker Saint-Gobain joining us exclusively in an hour's time. Plus, later today, we're going to speak to the CEO of Daimler Trucks. We've got more data coming through as well. Actually, a French manufacturer there kind of making the pitch. French manufacturing ticking a little higher.
Yes, and it's not all hanging together as one nice, clean story this morning, is it? No. Because we had this good data out of Spain. The French data, yes, it's ticked higher than the prelim number, but it's still below 50, so 47.1 for the French manufacturing PMI, and quickly the Italian manufacturing PMI rising to 48.7, but that is below where the estimate was at 49. So, you know, not an extremely clear picture, and that's reflected in a pretty unmoved euro.
Yeah, and the Germany numbers just hitting there, that February manufacturing PMI, 42.5. The prelim was 42.3. So really, out of all the data we've gotten this morning, Spain is the only one that actually was good again, which speaks to that theme of the kind of Southern Europe versus Northern Europe story. You are not seeing much of a reaction in Euro, 108.12 there, but you are, for some reason, in the 2-year, you are seeing a little bit of a pop there.
Interesting. I was just reflecting on what we've learned this last couple of hours. I was just reflecting on what we heard there from the Valeo CEO. One of the big themes that we've covered a number of times with lots of different CEOs has been EVs and the transition. You know, it looked as if we were all set for an electric future, and perhaps that is still the course. And the take, but we've certainly seen it being difficult in the short term. Well, the Valeo boss telling us there that EVs, it's the same destination, it's just a bumpier road to get there. I wonder if that turns out to be the case with that EV story, because we've certainly covered it losing ground a couple of times.
Be interesting to see whether ultimately the transition is still through the hybrid. A lot of people are looking at Toyota and what they've been doing and how successful actually their hybrids are turning out to be.
Some of the US makers, pivoting in that direction.
Ford are definitely moving in that direction as well.
In that direction, but also the fiscal policy really matters here. Tax credits, incentives here. Does that all fade in 12 months' time?
Take a look at residuals in EVs at the moment. It's an entertaining look, let's put it that way. We've got inflation data coming up a little bit later. We're going to be very much on top of that. We understand we're going to be speaking to Thomas Jordan later on as well today, so there's still lots to digest as we work our way through the rest of the day.
Absolutely. Data out of the US as well.
Oh, yeah. University of Michigan, Tim Forey's ISM Manufacturing. Love that.
I'm already exhausted at the thought of next week.
I was going to say, all prepping us for next week. We've got US story, we've got the UK budget, we've got the ECB as well. We're going to take you through it, but for now, the Pulse is up next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal?
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
To keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning and welcome to The Pulse, everyone. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. U.S. and Japanese stocks hit record highs as the Fed weighs data showing U.S. underlying inflation rose in January at the fastest pace in nearly a year. Thomas Jordan will step down as president of the Swiss National Bank later this year, ending an era where his institution was really at the heart of currency and banking turmoil that rippled around the world. Plus, China's factory activity fell for the 5th time in a row as weak demand continues to hamper the world's second-largest economy. We also preview next week's NPC meeting. But first thing is first, so as always, let's look at the European markets map. Again, the focus is firmly on what we heard in the U.S. So we're seeing a little bit of a lift to a lot of these stocks. You can see the IBEX of FTSE MIB getting between 0.5% and 0.8%. Banking and auto shares seem to be leading the gains. And again, this comes after the Federal Reserve preferred inflation measure, which is personal consumption expenditure, rose in January at the fastest pace in nearly a year. But it's actually also in line with estimates. Sentiment also got a boost from jobless claims data that indicated labor market is softening a touch. Now, Dell is also soaring pre-market after it reported a bumper sales and profit driven by the AI boom. Known for its PC business, Dell has attracted attention for its high-powered servers needed to run AI systems. However, Dell says, like many in the industry, the business is being held back by the availability of advanced computer chips. You can see pre-market Dell 21% higher. And commercial real estate lender New York Community Bancorp said it discovered material weaknesses in how it tracks loan risks. So wrote down the value of companies acquired years ago and replaced its leadership to grapple with the turmoil. Well, Alessandro Dinello is to succeed Thomas Cangemi as the firm's chief executive. And you can see pre-market New York Community Bancorp down some 21.7%. Now, to talk about all of this, we're joined from Munich by Ludovic Soubrand. He's chief economist at Allianz. Ludovic, thank you so much for joining us. I don't know whether there's been a change in expectations because of some of the data that came out, that preferred inflation data out of the Fed, but how many times are you expecting the Fed to go this year?
Good morning, first, Francine. I think the PCE numbers confirmed the CPI numbers, so for us, it was not really a surprise. We have the Fed pivoting by 75 basis points to 100 basis points this year. So markets are catching up with us because we had this call for over a year. But you saw the year-end rally and the craziness about the March pivot that would have been horrible, I would say, for the overheating of the U.S. economy. So we're still quite confident that the Fed has ample room to pivot in the second half of the year. But those numbers, I think Goldman Sachs just published their outlook saying the USA powers on. It's incredible to see how much the US still has in terms of engines of growth and inflation in this first half of 24.
Yeah, and Ludovic, it's pretty incredible looking at some of the metrics, also productivity really soaring. Is there anything that makes you uneasy? How long can the labor market actually stay at these strengths?
Look, normally election year in the US, like 2016, which would be a good example because there is a lot of uncertainty about the outcome, is a year of muddle through where you have some sectoral recessions in the US. So the cyclical sectors, construction, automotive are usually in down mode. And so that could create the end of the so-called labor hoarding that some US firms have been doing because they were waiting for the IRA, the Inflation Reduction Act subsidies. So we are, we expect the unemployment rate in the US to tick up a little bit towards the second half of the year. But to be fair, it's still a very tight labor market. You mentioned the jobless claims, and it's not something that is going to be tremendous in terms of, creating the room for even a bigger pivot from the Fed because the labor market is still very tight in the US.
Ludovic, it's very clear that today there's one story in town, and that's the fact that the S&P president is stepping down. We don't know who will replace him for the moment. There is a press conference a little bit later on, but does that change in any way how you're looking at Switzerland and the currency?
Look, I think, at least the past year for Switzerland has been all about financial stability, right? So in the end, people didn't look so much about the losses of the S&P. They didn't look so much at the currency, the strength of the currency or the weakness thereof. But it's true that I think Switzerland is a very important marker of this whole, normalization and pivoting world. Why? Because it's such an important, safe haven for the world. And it's also an important, location for financial for financial impetus, which has been a bit dented by the UBS Credit Suisse story. So I would say, of course, the next leader of the SNB is important, but to a certain extent, what is more important today is that, Switzerland reassures their taxpayers that the massive quantitative easing that has been done and given back to shareholders, you've seen the results, I think you were in Switzerland for those results, is something of the past. And that going forward, there's going to be even better surveillance on the banking sector in Switzerland. And I think that would be better for everybody, around, as you can imagine, because of the cross-border credit risk that has spilled over from that situation.
You're like the central bank whisperer. So what does the next SNB president need to be like? Is it more of the same? Do you need someone more radical? Do you need someone that focuses more on politics?
I think we live in a world where, you have to be a politician to manage the currency. Central bank independence is for the books. And I do believe that in an era where we have a lot more financial weaponization, we see that now is the situation between the US-China rivalry, but more generally, the situation on currency and sovereignty going back to the forefront. I think you need someone who really understands what is the business model and the economic model of Switzerland, which is a lot about value-added exports in a world where trade is actually quite muted. So I do think you need someone quite political, unfortunately. But that's the time we're in. It's the time of war economics to a certain extent, where currency is a weapon.
We also had this pretty incredible survey, actually, that Bloomberg put together, looking at what's worse. Is it worse that the ECB actually cuts too soon? And many respondents, a majority of respondents, think it's the big danger is the ECB cutting too soon rather than delaying it. Do you agree with that?
I would say yes, because then it will be seen as the ECB throwing the stagflation baby with the bathwater. I think if the ECB cuts too soon because of the supply side inflation risks we have compared to the US, because of imported inflation, because of energy inflation, if we cut before the Fed, I think markets will sanction the euro and will be long US, very fast. So unfortunately for financial markets, volatility reasons, I would say that would be bad for the ECB to cut too soon. But of course, as you can imagine, there is a social aspect to it. So you're in a situation of very asymmetric needs. The Eurozone is already in a no-landing zone. We expect GDP in Q1 to be zero at best, yeah? So I think there is, a growing rationale about re-extending credit into the economy to avoid the recession and to avoid certainly something where the European or the Eurozone is really stuck in a zero growth with still a bit of high inflation situation. So it's a catch-22. I still believe cutting too soon would be riskier in the short run because that would, completely catalyze this idea of the US overperformance and therefore sanction somehow the financial flows into Europe.
Ludovic, what do you do with, there's a lot of talk about, of course, the tightening, quantitative tightening, which a lot of markets focus on, but we tend to ignore. I mean, this is an important component for the ECB.
Yeah, but we tend to ignore till the moment that they report their losses, and you realize that, unfortunately, the balance sheet matters. I think it's very interesting that we are normalizing rates very fast, but we're not normalizing the balance sheet as fast. Why? Because of fragmentation risk, at least in Europe, right? But it's the same in the US. It's because of the very strong corporate leverage. And the spreads have been really low and narrow, right? So I think there is this idea that balance sheet will normalize at a much gradual pace to avoid that whatever it cost that we initiated in 2020 when we were really worried about a financial meltdown is not all for nothing. We didn't have this higher debt and higher inflation for nothing because we would reduce the size of the balance sheet of central banks too fast. But be careful because, of course, this is a contributor somehow, even if indirect and secondary, to the strong inflationary pressures that are still, rampant, in the US for sure, and somehow also in some places in Europe. But I would say the pace is the right one, but it's certainly not as fast normalizing as it should if we would really want to get demand-driven inflation and all these risks around rate price spirals and so forth back into their box. Yeah.
Ludovic, thanks so much. As always, we'll have plenty more from Ludovic Suivant, the chief economist there at Allianz. He's coming up shortly. Now, also coming up, we had inflation data from 3 of Europe's biggest economies yesterday, so we get the figures for the whole of the Eurozone. We look ahead to Germany. Actually, we'll focus in on Germany. That's next, and this is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Now, two stocks we need to look at pre-market. Dell soaring pre-market after reported bumper sales and profit driven by the AI boom. Known for its PC business, Dell has attracted attention for its high-powered servers needed to run AI systems. Now, New York Community Bank Corp has also plunged pre-market. That's after the bank said it had discovered material weaknesses in how it tracks loan risks, wrote down the value of companies acquired years ago, and replaced its leadership to grapple with the turmoil. You can see 25% lower pre-market for New York Community Bank Corp. Also, Euro area headline inflation data is due in less than an hour. Investors watching the state of the continent's economy ahead of next week's ECB rate decision. Well, our very own Zoe Schneeweiss joins us now from Frankfurt to discuss all of this. She's in charge, of course, of all of our central banking coverage. Zoe, so good to speak to you on TV. So we've had data out of Spain, France, and Germany already. What can we actually expect from the wider Euro area?
So we get that number in about 45 minutes. A reminder, in January, euro area inflation stood at 2.8%. Economists predict that the number for February will be 2.5%. So that's a nice slowdown, that this inflation trend that policymakers have been speaking of will be on display. Bloomberg's economics nowcast would suggest even lower, would suggest 2.4. Either way, that's not close enough to the 2% that the ECB does want to see, but it's obviously moving in the right direction.
So you and I, Zoe, have covered many Swiss National Bank pressers. Big news today that the president of the SNB, Thomas Jordan, will be stepping down after more than a decade on the job. You understand the SNB like no one else. Where does it leave the central bank?
So it's obviously quite a seismic move, him leaving. He has been the longest-serving central bank governor in the central bank's history. So in more than 100 years, no one ever served as long as he did. And he was just such a towering figure within the central bank and also within Swiss politics. Overall, Switzerland always is about continuity. And again, Jordan is not stepping down overnight. He's leaving in September, so we do have several months to go. Overall, Switzerland's continuity would suggest that the most obvious candidate to succeed him is his vice president, Martin Schlegel. Schlegel now has only been on the rate-setting panel since 2022, so not even 2 years now. And the third person on the governing board, Antoine Martin, only started in January. So it means we will have a very new guard there. Jordan, even before he was central bank president, was the deputy, and before that, the number 3 on that rate-setting board. So really, he has dominated the Swiss central bank like no other.
Thank you so much, Zoe Schneeweiss there in Frankfurt, who leads all of our coverage of central banks. Now, later this afternoon, we'll also be speaking to the SNB governor, Thomas Jordan, and I think there's a little bit of a press conference ahead of that TV interview. Now, let's get more from our guest, Ludovic Subran, chief economist at Allianz. Ludovic, the one thing that's been keeping, I imagine, a lot of economists up at night is commercial real estate, especially commercial real estate in Germany. Is Germany really now the sick man of Europe?
I don't think Germany is the sick man of Europe, but I do think that the property sector is under a lot of duress, right? Everywhere we see it, but as you can imagine, the atomized banking structure of Germany and the very efficient specialization, one would say, of some of these banks onto the commercial real estate sector create an additional layer of risk, right? And I think this is something we need to monitor. The good news, I would say, is I have the impression that there is a form of bottoming out, mostly because demand for construction is slowing down very fast, and there are still some supply constraints, right? So we see some, collateral damage, the insolvencies in the construction sector. We do see, and you've seen some events, some names, single names being at risk or being, singled out. But I do think that the bigger question we need to ask is what happens to the housing sector? Because no politician in Germany or in France want to actually support the housing sector with very strong fiscal. And I think that's a very interesting change of times compared to what we used to see before. So they consider this is out of their scope. They let the interest rate rise do their job to cleanse a bit the sector, which is a sector where leverage has been powering growth for quite some time. So something to watch, this real estate banking loop in general, I would say. That goes for the US, that goes for the UK, that goes for all of Europe. But it's true that Germany has really hit rock bottom, and we see that in the many leading indicators of the housing sector.
But Ludovic, what's the possibility of this becoming a bit of a doom loop, or some kind of big credit event that shakes financial world?
To be honest, when we scan the banks, the systemicity and the current real estate exposure, we end up with a very few number of very small banks. But as you know, if something happens, it's always how you manage it that matters. These famous bail-in, bail-out type of procedures. And that's why there is so much urgency to get the capital markets union going and so forth, because I think we're going to have some of these issues popping up, on credit risk and commercial real estate. So I'm not that worried about a domino type of situation. I wouldn't say even not at all, but I'm still very concerned about some special names in the banking sector where the doom loop for these particular balance sheets are quite strong.
Ludovic, finally, what's your take on Argentina? I know you call it a catch-22.
Look, I was in Davos when Milei was here, and he was like the gods of the gods. Everybody, all the libertarians attending Davos were so fan of Milei, and it took me some time to understand why. But I think everybody feels that Argentina is for sale, So they all want to have some of these mandates on trying to, power fuel growth in Argentina. On the ground, he's had quite a few political headwinds when it comes to passing his omnibus law. And I think the main concern for me is today there is a lot of popular support. But the social cost of the devaluation and the fiscal consolidation are massive. It really has a flavor of 2001, 2003. And so I wonder how long, the international scene is very keen of Milei. The local people are still keen on Milei, but when their purchasing power is really going to drop by 10, 15%, I'm not sure he's going to still get this popular vote. So I'm looking forward to see if he can really pass some of the massive reforms, even if they're watered down by Congress, and whether people are still with him, behind him, when there is a recession in the tune of 3%, as we expect in Argentina in 24, and the inflation is still high, right? Because it's not really getting under control yet. So that's where the popular vote could be eroding, and then the Milei halo effect could actually disappear.
Ludovic, as always, thank you so much for joining us. Ludovic Subran, Chief Economist at Allianz. Now, coming up, we talk from economics to geopolitics as dozens of Palestinians are killed near a convoy of aid trucks in Gaza. President Biden says the incident will complicate talks, but remains hopeful of a ceasefire. The latest from the Middle East next, and this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weird.
From the UK, and I'm the inventor of the gel razor, and today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype or manufacturing possibilities with investment or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel, hence I developed the all-in-one. The idea is You pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
For their remaining hostages, they may feel the need at that point to go into Rafah, but there's still no clear plan for what happens to the Palestinians who are currently in Rafah. Israel says they should be able to channel them north, but there's not really a path for them to go. And as we saw from this incident yesterday, these fatalities around this aid convoy in the north of Gaza, there's obviously still desperate situations happening. Northern areas of Gaza, central northern Gaza, the conditions for people there. So where are they going to go where they can be safe? And that's really a question as part of this. And now the US president is saying maybe not really Monday. They're obviously trying really hard. I mean, he had phone conversations yesterday again with the leaders of Egypt and Qatar. There are efforts to get some kind of ceasefire in, but they are running out of time to get it done.
We're also looking at pictures in Moscow. Alexei Navalny will be buried actually in Moscow today. What can we actually expect?
Well, we're seeing some initial scenes of that and obviously a little bit of a crowd gathering. Russia has been cracking down on the protesters. We've seen some protests since the death of Navalny, arresting those people. So making very clear they don't want to have a big scene today, but we are seeing some people gather. It was very difficult for Navalny's family to get a place to even have the funeral. They obviously want to make this into a moment. Also, Russia clearly does not. So it'll be interesting to see the size of the turnout, the behaviour of the police, obviously, around that. And then what happens afterward, because Navalny's widow, his wife, she's now trying to establish herself as that opposition figure in the wake of her husband's death. After this moment, what happens? Is the momentum still there for her? Particularly, can she get traction inside Russia? So in a way, we want to look beyond this moment also to see what is the trajectory of the opposition inside Russia. Vladimir Putin's going to get re-elected in a matter of weeks. He's going to have another term. Is there any room left for dissent inside Russia?
Roz, thank you so much. As always, Rosalind Matheson there, Bloomberg's EMEA News Director. Now, coming up, we're in conversation with the Chief Executive of an Italian challenger bank, Illimity, as Europe's banking sector faces a more uncertain year. That's next, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, have fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
This is Bloomberg.
U.S. and Japanese stocks hit records high as the Fed weighs data showing U.S. underlying inflation rose in January at the fastest pace in nearly a year. Thomas Jordan will step down as president of the Swiss National Bank later this year, ending an era where his institution was at the heart of currency and banking turmoil that rippled around the world. Plus, China's factory activity fell for the fifth month in a row as weak demand continues to hamper the world's second largest economy. We'll also have a preview of next week's NPC meeting. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, two stocks we need to watch out for pre-market. First of all, Dell soaring after it reported a bumper sales and profit driven by the AI boom. Now, known for its PC business, Dell has attracted attention for its high-powered servers needed to run AI systems. And New York Community Bancorp has plunged pre-market. That's after the bank said it had discovered material weaknesses in how it tracks loan risks. Now, it also wrote down the value of companies it acquired years ago and replaced its leadership to grapple with the turmoil. You can see New York Community Bancorp down 26% pre-market. Now, it's also shaping up to be a more uncertain year for the banking industry as a boost from rate hikes fade. The geopolitical risks escalate. Europe's lenders are also assessing the risk of the troubles in commercial real estate. So what does this mean for a challenger bank like Italy's Illimity? Well, Corrado Passera, the bank's chief executive, now joins us. Mr. Passera, thank you so much, as always, for joining us. I mean, it can't be easy being a challenger bank in these kind of environments. It's tough out there, interest rates, inflation. Like, what's it been like?
A few black swans, actually.
Just a few.
Just a few. In the 5 years of our short life, we went through a number of surprises. But year after year, without interruption, volumes have gone up. Now we are at 7 billion. Profits have gone up without interruption. Now we are well above 100 million euros profit per year. Very strong growth in revenues. That is at the end the evidence of what we are doing, and we are at 360 million. At the same time, in situations like this one, you have to be very careful in keeping capital strength, liquidity strength, quality of assets, solidity. I mean, you have to keep everything under control while you're growing.
But so how much do you worry, for example, about bad loans or people not being able to repay some of the loans?
Actually, that's not an issue for the time being. Certainly for our portfolio, we have an NPE ratio of 1.2, so it's not a problem. But at the system level, we don't see, for the time being yet, any real increase in the deterioration of the portfolios. That's a good sign. Probably something will happen, but you know, especially Italian banks have really cleaned their balance sheet in the last few years in a major way.
Mr. Passer, how much do you worry about 2024? So 2023, you could argue, is actually quite benign. Right now, you have a very uncertain geopolitics that seems, frankly, to be getting worse by the day.
Yes.
You have uncertain interest rates for the moment, with the economy that could really take a downturn.
Yes, you mentioned uncertainty, and probably the main risk we have in front of us is the accumulation of uncertainties: growth, geopolitical risk, technology, democracy, health, everything. So that's the environment in which CEOs have to manage their companies. I believe that we are in the zero-something level of growth, and that's not enough. That is the main concern for me. We have to avoid recession because social malaise might become too high. We have to work at the same time on productivity and on poverty, and growth is the answer to it. So monetary policy becomes crucial.
So we had a survey, actually. We surveyed economists who see one fewer cut now in 2024 than a couple of months ago, and basically the consensus was that the ECB cutting too soon would be worse than delaying a cut. Do you agree with that?
I believe we should give a clear sign that monetary policy has done its job. So maybe after that, not too many reductions one after the other, but let's give a clear evidence that what monetary policies could do has been done. Now we are entering a new phase. We have to foster growth. We have to avoid recession. So I would really expect a clear sign in the direction as soon as possible.
Do you start worrying actually about consumer behavior in Italy? Do you see anything in the way that people are lending, spending, using that's being hurt by inflation that makes you worry about a financial credit event happening?
High yields have made investments more difficult. And that's why I strongly suggest our government, but Europe in general, to do whatever they can to reward companies that invest in innovation, because that's crucial. I mean, for Europe, for Italy, for any other country. So, for example, any tax advantage you can provide to companies that invest, tax credit is the main instrument. At the same time, in my opinion, we should accelerate what I said since 5 years ago, federal investments in technology. Europe is losing the opportunity to be part of the new world. We are lagging behind in terms of growth.
Private companies.
Yes, but you have to do what the United States have done, what China is doing. At the federal level, you have to really reward, help, incentivize, subsidy, whatever you can do to help, to encourage companies to invest in innovation, because we are really out of the ranking as of today, and that's a liability, that's a weakness we have to cope with.
So Illimity is 5 years old. Congratulations.
5 years old, yes.
Are you working on a new business plan, and what will that look like?
Growth where we are at our best. Credit to SMEs with growth potential, with the will to go through the restructuring. So these are the two main areas. Going concerns with ambitious projects or with the will to go through their problems. That's really where we give our best. Less or even no direct investments in NPL. That's less interesting.
Right.
It used to be part of our business. It's not anymore. We concentrate on going concern. We concentrate on SMEs that can grow, that can pull the growth of the country.
So your share price has had a bit of a tough time.
Yes.
I think it's down 13% since November.
Yeah.
It's down significantly from when you IPO'd. What's the underlying reason of it? I'm sure you're disappointed of that.
Absolutely. But we know what we have in front of us. So, I mean, we are not exploiting the increase in spread that the traditional banks are enjoying. We always remunerated our deposits. We want to keep doing it because it's safer from a balance point of view. So we are not one of those banks that are really getting profits from yields. At the same time, our exit from the NPL direct investment will help. At the same time, our results, the continuous growth, will show the market that we are worth much more than we are presently on
Mr. President, are you telling me that as a challenger bank, you also have to be more generous with your depositors and the traditional banks?
Yes, not generous. I mean, it's really a matter of always keeping a balance between the duration of the liabilities and the duration of the assets. I mean, I believe in that. I mean, certainly you give up some profit margin, but your risk profile is much stronger and your long-term perspective is stronger. So that's our choice. And 100 million worth of profit and 7 billion worth of volumes is the evidence that it's a reasonably good strategy.
Would you take it back private?
That's a question you shouldn't ask to a listed company. No, nothing on the table yet, but in any case, I wouldn't answer to that question.
What's your biggest concern over the next 12 months? I mean, we talked about, possible mistake from interest rates and from central banks. Geopolitics are extremely difficult, actually, to navigate, to price. That's your main worry?
That's the main word. I mean, we are having at least two main war risk very close to us. That's the main thing. I would avoid a recession because if you add to this geopolitical uncertainty also more social malaise, with so many elections coming out and with so many populists using these uncertainties to trigger fears in the people, that might become the major risk.
Do you feel like Europe as a bloc is a bit weak? Because you don't have...
It is.
Yeah.
We certainly feel a lack of leadership. Europe is one of the global powers, but China is doing more, United States are doing more, India is coming up. Middle East is creating a sort of new pole of power, and Europe is not expressing what we could do, because we have to be aware of our social and economic model that is safer and probably more reliable than others. We are big. I mean, we are still one of the very big markets. We are not using our strength, and we are not investing on the future. That's why federal investments, so money that we raise together in a solidaristic way, and investments we do together to foster innovation, R&D, common infrastructure, has to become the priority.
Mr. Passera, as always, thank you so much for dropping by our London studio. That was Corrado Passera, Illimity's chief executive. Now, we're also getting some UK PMI readings. Of course, it's 9:30, so we always have a bit of UK data. Manufacturing PMI coming in at 47.5, pretty much in line with estimates, actually a touch above. It's the 19th consecutive month of contraction, but the highest reading since last April. So there you go. You can see sterling 126.27. Coming up, the French construction materials company Saint-Gobain results topped estimates as it agrees a takeover deal with the Australian rival CSR. We'll be speaking exclusively to Saint-Gobain's chief executive, Benoit Bazin. He's coming up next, and this is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons.
another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Pleased to be joined by the Chief Executive of Saint-Gobain. He is Benoit Bazin. Mr. Bazin, thank you so much for joining us. There's a lot going on, certainly in your space and in your industry. The construction and renovations market for new homes and office buildings have been plunging after a pretty incredible couple of years. So what does this mean for Saint-Gobain going forward?
Well, we have delivered a very strong set of results for 2023, record operating margin, record cash flow. It means that the transformation of Saint-Gobain has delivered great results above the initial targets. And we have also given a strong guidance for 2024 that despite certain difficult markets going forward, notably in Europe, we are going to deliver the fourth straight year of double-digit margin. So I'm very confident about the prospects of Saint-Gobain going forward and very happy that we'll welcome soon Australian colleagues. It is a fantastic acquisition in the fast-growing Australian market.
Yeah, but Mr. Bazin, is there something then that analysts aren't quite understanding? I know that share prices fluctuate, but at the moment your share price is down 4.5%. Were they expecting more?
I think they don't realize all the support and the confidence we have on the margin. We adjusted a bit on their expectation for slight negative organic growth. That may have been for some of them the slight difference versus the consensus. On slightly, we guide for low single-digit volume down and a slight negative price for technical mathematical effect versus the strong average that we had in 2023. And I think the magnitude of also the spread on price cost with energy, raw materials coming down may have been a bit underestimated this morning. So it's the first time that we guide at the beginning of the year for double-digit margin. So that shows the confidence that we have on the transformation of Saint-Gobain and all the structural benefits. So again, I think it will take a bit of time for everyone to realize that, but it's first time we guide on the double-digit, and it will be the fourth straight year of strong performance of Saint-Gobain. So I'm very confident that any weakness is actually a strong point for some shareholders to rally.
You're very good, Mr. Bazin. So can you give us a sense of, these worry about construction and renovation markets, the fact that in many countries in Europe, they're taking a plunge. What does this mean for Saint-Gobain going forward?
Saint-Gobain, we are all driven by renovation. It's 60% of our sales in Europe. The new construction in Europe is only 12% of our total sales, and that's the area where we were negative last year and we will be negative in 24. But quarter by quarter, country by country, reaching a trough. So that's the good news. We have already reached a trough, for instance, if I take Poland, Eastern Europe last year, where we are up in volumes. So that's the new build in Europe, which is the only area where Saint-Gobain will see negative volumes in 2024. In the rest of the world, North America, Asia, emerging markets, we expect growth, and that's positive. And now, after the huge transformation of Saint-Gobain that we have done over the years, we have two-thirds of our profit coming from North America, Asia, emerging markets. So maybe there is a bit of disconnect between the top line, where we are still a bit more driven by Western Europe, but the profit, where we are two-thirds driven by North America, Asia, emerging markets, and that has been the success of Saint-Gobain and will remain so going forward.
And I know you've also been reshaping, of course, Saint-Gobain's portfolio. You've exited, for example, distribution of your construction products. Do you still want to supply glass to the automotive industry? Like, how will you continue reshaping your portfolio and maybe exit some of the markets?
We are all driven by value creation. And, the return on capital employed has been above 15% consistently in the last 3 years. total shareholder return has been above 25% per year in the last 3 years. So it's all about value creation, and therefore continue to make some trade-offs on our perimeter with some exit of businesses which are far from our strategy or far from our financial expectations, and then integrate well some nice acquisitions. The recent ones in the US on construction chemical have created value on year 2, 1 year ahead of plan. So I think also Saint-Gobain has shown in the last 5 years a very strong, high-level reputation on how we acquire and integrate fantastic businesses. So it's all about value creation, and yes, continue to reshape the portfolio. We are committed to that with in and out along this goal of value creation for our shareholders, good integration of acquisitions. Australia, I'm super confident about what it will bring to Saint-Gobain. We have more ideas in North America. We have more ideas in construction chemical. And yes, we will also continue to divest some businesses.
So when you say more ideas, you'd be looking to buy companies. I know CSR is a big acquisition, so that will probably take time to pull it completely through. But is there anything in emerging markets or elsewhere that you'd be looking to buy?
It's, of course, smaller size, but we did some in Malaysia last year, in Egypt, in Mexico, in Brazil, in India. We entered into insulation in India, where we have a very strong position on glass and plasterboard. So, yeah, there are many ideas around the world on emerging markets. And also in North America, we doubled our size in Canada in the last 2 years, and we still have ideas to grow in North America. So we have two very clear, and we have been very consistent on our strategic axis for growth. One is geographic development, North America, Asia, emerging markets. And second is construction chemical. We will continue to push for that. We had, for instance, 11 acquisitions in construction chemical last year. And the integration of Chryso GCP is ahead of plan. We improved the combined margin of more than 400 basis points. That's a huge achievement. Yeah. We had more than 5% organic growth on those businesses. So a lot of good prospects for Saint-Gobain going forward.
Mr. Bazin, thank you so much for joining us. That was Benoît Bazin, the Chief Executive of Saint-Gobain. Now, coming up, the world looks on as China's NPC meeting begins. We preview the many challenges faced by the leaders gathering in Beijing. Our Chief North Asia correspondent explains next, and this is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Bloomberg News Now. now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The conversations that matter, the insights you need. This is A Pulse, and I'm Francine Lacqua here in London. Now, the so-called two sessions, the National People's Congress and the Chinese People's Political Consultative Conference, begin on Monday. Our chief North Asia correspondent, Stephen Engel, looks at the many challenges faced by leaders gathering in Beijing.
The National People's Congress, or NPC, is China's annual session of parliament, convened usually every spring in the Great Hall of the People next to Tiananmen Square in central Beijing. Essentially, the NPC sets the political agenda for the year ahead, when the nearly 3,000 delegates from around the country get their marching orders on day one in the form of a lengthy work report from Premier Li Qiang. While regarded as the highest organ of state power, the NPC nevertheless operates under the direction of the Communist Party of China. The NPC, by design, legislates and executes the directives of the party. The roughly two-week affair is colloquially known as Lianghui, meaning the two sessions, as the NPC is preceded by a gathering of the Chinese People's Political Consultative Conference, or CPPCC, an advisory body supposedly representing views from the broader society and business community. Even though party membership is not required to be in the CPPCC, it is nevertheless directly supervised by the Communist Party.
Well, that was Bloomberg's chief North Asia correspondent.
Bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo.
Said it had discovered material weaknesses in how it tracks loan risks. Now, it also wrote down the value of companies it acquired years ago and replaced its leadership to grapple with the turmoil. You can see New York Community Bancorp down some 28.6%. Now, of course, the story today is European stocks in general rising over some of the relief after we got, of course, the U.S. inflation figure. Now, moves in global equity markets yesterday were positive because we had the Fed's preferred inflation measures, and that was on personal consumption expenditure. This is the data that we know the Fed looks at. It rose in January at the fastest pace in nearly a year, but it did match economists' forecasts. At the same time, some of the sentiment was soothed, I guess, by jobless claims data that indicated the labor market softening a touch. A reminder, also, the other piece of news is that the S&P governor will be stepping down in the second half of the year, and we'll be speaking to him a little bit later on. That conversation with Thomas Jordan this afternoon. Up next, Bloomberg Brief.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time, I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So, yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Wall Street kicks off March at fresh records. Reassuring inflation data lures in the bulls.
NYCB plunges in the pre-market. It takes a $2.4 billion hit and flags material weakness.
And China's factory activity shrinks for a fifth straight month as weak demand continues to hamper the growth story.
We're getting a drip feed in of European data. The first one to come out that I noticed is Italy. I know we're waiting for the Euro area. Italy comes in 0.9% CPI year over year. The estimate was for 1%. So, Manus, at least Italy is weaker. When it comes to the Euro area Feb consumer prices up 2.6%. Hotter than expected, Manus. It was expected to be 2.5.
And on the core, and this is where it gets more interesting, the core, Danny, we were expecting a sub 3% reading on the core. That comes in at 3.1%. So this is a slightly disruptive reading to the inflation narrative. Just reflect back to the PCE that we had in the United States yesterday. And of course, at the top level, it was in line. The super core, however, was hotter, the hottest in a year. So this is the disruptive element. Euro pips a little bit higher. I wouldn't call it disruptive in the euro market at the moment. 108.20 is where we are. Rest of the markets, let's just reflect back on those bond markets and on equity markets. I know you've done the month that was. Exuberance and euphoria, but we'll come back to that in just a moment. This is where we are at the moment. 10-year yields, Danny, tick up at 1 pip. We were tense and nervous ahead of the PCE yesterday, but of course, you know, the market doubled up a little bit. We had a lighter print on the PMI at 44. And PIMCO, I like what PIMCO are talking about today. They're talking about U.S. fiscal profligacy. Swelling deficits will drag bond markets back to the future. We can talk more about that in just a moment. You've got Bitcoin flashing hot this morning, up another 1%. 673 million bucks flooded into the ETFs on Wednesday. Mike Novogratz, however, has said we may well get a correction back to the mid-50s, 50,000. We're in a price discovery mode. One day it is yen bid. The next day we are offered, this is the dollar bid this morning because Ueda comes out and on Seats Takata's comments from yesterday, the price target is not already in sight. overnight. And so you see this little bit of a flurry to the upside for the dollar, down for the yen.
Some very slight whiplash there. Now, when it comes to these equities markets, Manus, it's March 1st, in case you didn't know. And what a strong end to February. Another record for the NASDAQ. Release the balloon drop. That also was led by NVIDIA. A record from them, too. The good times keep on rolling. Although, NYCB, that is what we would call not good times. They did flag some material weakness in how it tracks loans. They're going to replace leadership, and they will miss their deadline for filing. It's 10K, so those dropped more than 20% in the pre-market trade. That should be at the bottom of your screen shortly. Meanwhile, the Nikkei, another balloon drop for you, Manus. We're almost at 40,000. We close up nearly 2%, again, a record. Now, you mentioned the month that was. Let me put the scores on the board for you, because it is remarkable to see what has happened. The Mag 7 trading at a record high, their biggest gain in a month in 7 months. Bitcoin, you mentioned this, up 44%. But this is the remarkable thing, Manus. Among all of that, we had the repricing in the front end of the curve, up 42 basis points, yet risk was very well bid.
I was very surprised. The one thing I read in the car on the way in this morning, which was, it's on the MLive blog, what is your risk in March that the dots are shifted to two cuts, rather than 3 cuts, because of this narrative from all of the Federal Reserve in terms of it's going to be a bumpy road. We are not in any hurry. I like what Mary Daly said yesterday, which is where she talked about there is no imminent risk to the U.S. I'm going to qualify a little bit. I'm going to paraphrase. She says the economy faltering. I'd say this is much more a U.S. economy, perhaps relative to the rest of the world. That special, splendid position that it has is fundamentally different.
And it's showed up in the corporate earnings. And that's why there's this optimism around U.S. stocks. Is there any alternative? Our next guest is certainly optimistic on equities. He writes, while equity valuations are somewhat elevated in the wake of the run year to date, especially in the U.S., we think equities can deliver reasonable returns owing to valuations overshooting and better earnings growth. Joining us now, pleased to say, is the author of that, Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. So, Peter, stocks can go higher from here. Valuations have moved higher year to date, but we are at record highs. Does that not make you nervous?
Hi, Danny, and thanks for having me. Well, we shouldn't mistake the level of markets for the valuation and the underlying fundamentals. And look, what a difference a year makes. You know, this time last year, everyone was convinced there was going to be recession and there was massive uncertainty about where rates and inflation would peak. And now we're seeing the other side of that, with confidence in growth, inflation, and interest rates coming down, albeit some question about the speed, but the direction, I think, is clear. Now, we have seen a very powerful rally since the end of October of last year, but we have to put it in context. You know, the median stock, even in the US, is pretty much flat on where it was just before the Fed started to raise rates. So we've seen this very powerful rally, but it's come from a position where investors were quite worried about recession and inflation. Those fears are receding, and as long as the earnings continue to grow, we can see, I think, some upside to equities and better returns than in other major asset classes.
Peter, good morning. Good to have you with us. With all of that said, I was surprised that you've gone from 5,100 to 5,200, which is a very sort of stable voice, perhaps not as euphoric as the TV journalists are. And I want to get your sense. This is the debate that I had with Deutsche Bank yesterday. We talk about euphoria, all of these asset classes rising. But yet, the question is, do you think that these markets are positioned in a stretched way? Binky Chadha at Deutsche Bank says, no, Manus, it isn't. I want to get your sense at Goldman's in terms of how stretched this narrative is of euphoria.
I don't think it's euphoria. Perhaps we can talk about the dominant companies which have really been driving most of this rally, not just in the US, actually, but in Europe as well. I don't think the valuations yet are consistent with any kind of bubble or mania or really strong speculative sense of excitement. I think they're reflecting pretty good fundamentals. Now, having said that, valuations are quite full. You know, if you look at the S&P, it's trading at the high end of its range over the last 20 years, even if you exclude the big 7 tech stocks. And we do expect to see relatively moderate profit growth this year, about 8%, for example, in the US and Japan, little bit less than that in Europe. But as long as profits are growing, we're avoiding recession, and interest rates are coming down. Yes, some of that has already been discounted, but we would expect to see moderate upside index returns. But I do think it's going to be more about alpha than beta.
Right.
In other words, selectivity has already been very important over the last year. I think that will still be the case.
Peter, I think, Jeff, you from BNY Mellon, speaking to Manus and I earlier this year, put into context something that a lot of people are feeling. This idea that it's been just too easy so far this year. You could just buy NVIDIA, you could buy Bitcoin. People are going crazy with call options again, those retail traders, and in things like Palo Alto and even ARM, for example. Do you get the sense that this kind of, again, even if the fundamental earnings are there, but in other pockets of the market, this speculative and perhaps worrying behavior has returned?
Well, I don't think it's been that broad-based yet. You know, if you look at in the US, the other 493 stocks or the Russell 2000, the valuations are quite a bit lower. And indeed, as I said, the median stock actually has moved sideways for the last couple of years. It hasn't gone up anywhere near as much as those very dominant leading tech stocks. The same is true in Europe. What we call the granolas, the biggest 10 or 11 companies, are very dominant. They account for a quarter of the index of 600 companies, and they, again, have been leading. And the reason that these companies have been leading is because they're fundamentally generating very strong profit growth with high margins. They have strong balance sheets. They've got net cash. So actually, they've benefited, in a sense, from rising rates. And they are delivering fundamentally. I do think that as we start to get interest rate cuts, we'll be seeing more of a broadening out of this rally towards other parts of the market, maybe even including things like small caps, which have generally been quite weak in most markets. But I don't think that the rises that we've seen are really speculative, because they are reflecting, very, very powerful profit growth, particularly in the biggest stocks in most markets.
Peter, can we just build upon that narrative? Many people come on the show and we focus on how do we go for breadth? What is the process of searching for additional return? You just mentioned the granola. Citi call it the Super 7. And I'm curious to know, in terms of allocation to international markets, obviously the alpha will be in the United States of America. Are you preparing to increase your allocation to Europe and Japan? Japan is on fire, isn't it?
We have, and it's already, in fact, last year, Japan was our favorite market, and it is this year. And I think there's a strong story. Again, yes, it's finally broken out of the previous high that we reached back in 1990, but the fundamentals have much changed. You are seeing nominal growth in the economy because the economy is finally growing and inflation is picking up and companies are making a claim on that nominal growth. But there's a good micro story as well, as you're beginning to see more companies reform and improve their shareholder returns. Europe as well, we've liked, and we're really arguing for more geographical diversification. You know, in the last year, for example, the Euro Stoxx 50 performed pretty much in line with the S&P. Not many people recognize that. The biggest 11 companies that we call the granolas in Europe, since the beginning of 2021, up around 65%, very much similar, in fact, to what the Magnificent Seven in the US have done. So I think choosing pockets to diversify geographically, restructuring stories in Japan, in dominant, stable growth companies in Europe, as a complement to some of the great companies in the US makes a lot of sense.
Peter, I know you like equity over credit, which perhaps makes sense given your equity tilt at Goldman Sachs. And we have seen this huge surge into credit. We've seen spreads compress. We've seen issuances come off. Is it your estimation that equity is just a more attractive return, or are you seeing cracks in that red-hot credit market?
Well, I think, risk premium are very low in the credit market now. And indeed, look, I think we should acknowledge that most asset classes are pretty fully valued. Bonds, given that they're already reflecting expectations of falling policy rates, credit spreads are extremely tight, equity valuations in absolute terms are high, and risk premia are relatively low. So we do expect overall lower returns at index levels, but I think equities provide a better balance. What we have is some reasonable dividend growth with earnings growth as well. And indeed, if rates don't fall as quickly as the market has been hoping, and that's because of stronger growth, I think equities are a better place to be than credit, given the relative valuations at this stage. So we're actually underweight of credit and overweight of equities in our recommended asset allocation. I think that's a good sort of hedge for taking on more equity risk.
You just make sure that you stand tall at the morning meeting there, Peter, with those credit boys and girls, and just remind them who's going to deliver for the rest of the year. Peter Oppenheimer at Goldman Sachs, our guest this morning on the markets. Let's get you some of the other stories that are trending on your Bloomberg terminal this Friday morning. The SMB president, Thomas Jordan, is stepping down at the end of September. Jordan has been the Swiss central bank's chief for more than a decade. An SMB spokesperson declined to comment on who could succeed him. Don't miss that interview with Thomas Jordan later today.
Russian opposition leader Alexei Navalny will be buried today in Moscow amid heavy police presence. Riot police have been deployed near the church, and metal barriers were erected on the streets ahead of the funeral service. Navalny died on February 16th after falling ill in a remote Arctic maximum security prison.
Congress has approved temporary funding to avert a partial government shutdown on Saturday. The interim measure would extend funds for some departments through March the 8th and others through March 22. The White House has said President Biden supports the temporary funding.
Scores of Palestinians were killed and injured in a shooting near a convoy of aid trucks in northern Gaza. The facts of the deadly violence remain in dispute. President Biden says the incident will complicate talks, but remains hopeful of a ceasefire. Talks led by the U.S., Qatar, and Egypt are underway for a pause in the conflict to allow for more aid.
Coming up on the show, China's factories slow, demand remains weak. We examine the recovery and the prospect in China.
And New York Community Bank struggles persist, with the regional lender warning of weakness in loan oversight, shares plunging more than 27.5%. This is Bloomberg.
Connection lost.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show, premieres around the world Monday at 9 a.m. Hong Kong time on Bloomberg. Context changes everything.
Bloomberg Brief. It's Friday. I'm Manus Cranny. Danny Berger alongside me. We didn't break anything, did we?
Not yet.
Not yet. Let's talk about data. We've had the Chinese factory activity shrinking for the 5th straight month. That was the February set. Weak demand remains the obstacle to the superpower's economy. Tom McKenzie is with us. So, Tom, it's a bit of a dent in the manufacturing side. The services side was a little bit of a glimmer of hope. How do you put the China story in context for the first 2 months of the year?
Yes, as we say, 5 straight months in contraction, 9 months, by the way, out of 10 when it comes to the manufacturing sector. And it is the domestic demand story that is weak, as well as that external demand picture as well. And that is the drag on manufacturing. As you say, when it comes to services, a brighter picture, firmly in expansionary territory. But Bloomberg Economics, they actually say, look, this is unlikely to be sustained. There was a lot of tick up that came through in terms of travel and leisure spending over the Chinese New Year holiday period. That fed into the services picture that came in, again, brighter than some had expected. Going forward, though, again, Bloomberg Economics and others saying what you need to see is a more robust policy response from officials. We may get that, of course. It's the National People's Congress. It's the parliamentary event. Starts on Sunday. The big ticket item is on Tuesday with the work report. That's where you look for the target around GDP and any additional detail. And investors will be, of course, scrutinizing that. Deflation remains a problem. The real estate crisis continues to drag on sentiment. Those issues need to be addressed.
Well, speaking of, weaker demand domestically, it does seem like some big international companies, American companies, are having to look at price cuts in China. Apple is one of them. I should say my iPhone 12 is broken, so maybe I need to go to China to buy a new one. But they've slashed the price of iPhone 15s by as much as $180. How much of this is about competition, Tom, versus the economic story in China?
Yeah, that's a really good question. Look, this is a confluence of events. So yes, you can pick up that $180 price cut now on your iPhone 15. If you're looking for that upgrade, Danny, you're still on the iPhone 12, my goodness. You're at the cutting edge of tech.
I'm behind.
So the upgrade is needed, iPhone 15. The problem is the iPhone 15 hasn't done very well in China, clearly. In fact, in the most recent quarter, their sales of iPhones fell about 13%. That's the worst performance they've had for years. You're talking about what's going on here. Is it the economics? Yes. Clearly, the consumer is feeling challenged. The sentiment is just very bleak amongst your consumer in China. And then there's the other aspect. One, Huawei is performing really well. Really solid products, really taking the competition to Apple. Other competitors out there as well, of course, across that market. And then there's the ban amongst some state-owned enterprises. And don't forget, they employ hundreds of thousands of people. So those three things are really weighing on Apple's prospects. And you make the point, look, Apple are reluctant to push through these price cuts. Official price cuts came through in January. These are not official price cuts. These are resellers cutting the prices. But nonetheless, it does point to the challenge there for that company.
Okay, Tom. And of course, we have Tesla again offering $1,000 to buy your Tesla before March. So that's just another form of a price cut. It's just a form of incentive. Tom, great work. Catch Tom on his social media. He explains things a lot more diligently and clearly.
He also anchors the show too, not just social media. Catch him everywhere on all the mediums.
That's productivity. Tom, thank you very much. Tom McKenzie there. On the very latest in China, we'll wrap up these markets for you in just a moment. This is Bloomberg.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
DOJ or other authorities
Could face bigger challenges next.
Was going to keep Real World Cup. This is a 3
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Danny Berger alongside Manus Cranny in New York. Manus, what do you do if you're the richest man in Asia and your son is getting married? Well, you hire Rihanna, of course, and you invite a who's who of global CEOs. To be fair, this isn't the actual wedding. This is Mbani's son wedding of Reliance Industries. It's a pre-wedding celebration.
Well, when you've got $110 billion, I think you can probably afford to hire Rihanna. This is his son, Anant Ambani. Now, this is almost like a sort of small Wall Street meets Asia, Middle East conference for money and deals. Call me the skeptic. But of course, there's Zuckerberg. He's been on a tour of Asia. He will go. Larry Fink's going. Bill Gates, we understand, will go as well. And then you're going to have a host of other people as well there. Yasser Al-Rumia, he was in Miami last week. He's going to be there. So this is a who's who of powerful deal makers. There's the Alphabet co-founder.
Exactly. I mean, this is the important thing, is it's not just, I mean, it is a social occasion, it's going to be flashy and whatnot, but I think what this also emphasizes is how large Reliance has gone and how important it is in the economy. For example, Bob Iger is going to be going there, and Disney in India just had a joint venture, just had a merger with Reliance. So it just shows all of the business ties that Reliance Industry has across the globe.
And this is reflected in these social gatherings, his kids that got married before. Also there, Ivanka Trump is going to be there. You got James Murdoch on the way. We understand the founder of Blackstone, Schwartzman, is going to be there. So it's almost like a fest of M&A, private equity, meets tech, and a little bit of glitter from Rihanna.
By the way, when his daughter got married in 2018, Beyonce performed. I wish I could go back in time and secure an invite. Who am I kidding? I'd never be invited.
I don't think he's got any more kids.
Too bad.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Mead at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger. Here's what you need to know.
Wall Street kicks off March at fresh records. As reassuring inflation data lures in the bulls.
NYCB plunges in the pre-market trade. It takes a hit of $2.4 billion and flags material weakness.
And China's factory activity shrinks for a fifth straight month as weak demand continues to hamper growth.
What a February it was. I can't believe it's March already. That makes no sense, but here we are.
Racing through 2024.
I mean, if we're already at a NASDAQ at a record high, I mean, where do we go from here? Peter Oppenheimer thinks it is up. Let me show you what these markets are doing. We are putting losses on the board. We're at the lows for the pre-market session. We actually started more positively in the day, so this is a turnaround. We had done well yesterday because, who cares about 6-month annualized inflation now above 2%? Who cares that it was a very hot January reading? If you look at core, we can look through that because we know that the Fed is not going to be cutting in March. S&P futures down about 1/3%. NASDAQ futures down 0.2%. Perhaps it is the nerves around ECB that is sending this market for another loop, down some 26%. NYCB in the pre-market session, flagging some material issues when it comes around their loans and also doing leadership changes. And they're also not going to meet their deadline for filing their 10K. But this closed before we got the drama of futures selling off. The Nikkei up nearly 2%. Man, we are so close to the beautiful round number of 40,000.
And this market does like round numbers. And we had a clear message from Peter Oppenheimer at Goldman Sachs, didn't we, Danny, which is we're not in bubble territory, we're not at stretched levels, and they've upped their game on where they see the S&P 500 for this year to 5,200 from 5,100. Now, the bond market, the conundrum, 422, super core, the highest in a year, and yet this bond market, you're going to get the March dots. What's the risk in the March dots going to 2 cuts rather than 3 cuts? That's on the blog this morning. Of course, the market doubled down slightly yesterday. Not only did it get an inline headline PCE, but it also had the Chicago PMI coming in lighter. Now, PIMCO say we're going to go back to focusing on fiscal deficits. That will bring the bond market back to reality. Mike Novogratz was with us yesterday talking about Bitcoin. He did flag you could see price discovery mode at the moment, coming back to around $50,000. It is a possibility on that. We're up this morning. Again, the money just flowed into the ETF. $673 million went in on Wednesday. BlackRock just went, I want it all. They pretty much got it all. And Ueda is out going, I'm in charge of the Bank of Japan. Very clear message from Governor Ueda. The price stability, the price target is not already in sight, and just that's essentially saying, Mr. Takata, get back in line. So we've got the dollar bid and the yen offer. Danny.
I say, man, this is such a confusing market. I mean, equities have turned around in the space of 30 minutes since we started the show. They were gaining. Bonds are barely moved despite the fact that ECB data, European CPI data, came in a little bit hotter. But maybe This is the opportunity where you buy the dip. If you're in team Peter Oppenheimer, where you say earnings are really strong, it is supported by fundamentals, this market. Sure, Mag 7 has gone off, but the rest of the market is basically flat on the month. Maybe look at a day like today where things are a bit soggy and you just buy.
Look, I think everybody's looking for those opportunities in Mag 7. He talks about the expansion in margins and the sales, and that verifies the reason why you want to be long Mag 7. Also very bullish on Japan and on the granolas. Other people call them the Super 7. Danny and I did have a lesson on equities this morning as we settled in. Some call it the granolas in Europe, and some people call it the Super 7, according to Citi, but quite bullish there.
Yeah.
But back to the data, you mentioned it. We had the European CPI, both at the headline and on the core. Joining us now is Sandra Horsfield, economist at Investec. So, I mean, it was a little bit of a surprise, 2.6% on the headline. That's above the median estimate, and the core being above 3%. Will this unsettle the ECB in any way? It's just reminding us all that the road to target in America and in Europe is going to be harder than we all presume.
I think you've hit the nail on the head here. It is always going to be a bumpy road, and we are still seeing very much the pattern that was laid out. Yes, we're getting lower energy prices. Yes, we're getting lower food prices. All of that is helping. We're also getting effects from China, for instance, struggling and boosting its manufacturing output. So the goods price side in Europe is being pulled down. But the big but is the service sector. Much like in the US, we have service sector inflation failing to come down much. Yes, it is trending lower, but only slowly. So until we have more wage data to give comfort, we're sort of stuck in a no-burn zone as far as bond markets are concerned. I think that's the main message.
I mean, it is just remarkable, the Teflon nature of these markets. You get core PCE, very strong yesterday. I mean, yeah, sure, we didn't think there'd be a March cut. And here you have ECB figures for Euro area inflation coming in stronger than expected too. And yet again, it is a market that doesn't care. Bonds actually started to rally in Germany after this data came out. We know it was a strong day for the bond market yesterday because, again, the data was expected. But Sandra, do you expect that we might get something that unseats these markets more? Are we too sanguine at this moment?
I think it's quite difficult. At the moment, we feel very range-bound. And I think the real question is indeed, in Europe, what happens with wage data going ahead? For now, the jobs market is still tight, so it's hard to see exactly where there would be that much of a slowdown coming. But that has been very much flagged. I think the sort of realization that we're not going to get quite as rapid rate cuts has taken place, and markets are now waiting for the next impetus in one direction or another. For the time being, it's just simply not there, so we're all in wait-and-see mode.
I mean, those bunds are on fire. They were down 15 pips, and they're now down 3. So, I mean, we can use all the cliches in the world, whether it's sort of sell the rumor and buy the fact, and the fact was not any more terrible. Can we pivot back to the US? We had the PCE, just to tag along with where Danny was going. You draw the distinction, Sandra, between the personal income, which was hugely strong at 1% relative to perhaps a more constrained personal expenditure. Have you had time to reflect on that and perhaps draw any analysis?
There were some special factors there. We had government transfer payments taking a big part of why there was such an increase on the income side. Taxes took some of that away. If you look at the spending front, it has been softer. The difficulty always is at this time of the year, seasonal adjustment. And we don't quite know to what extent what we're seeing at the moment, the weak numbers, were they affected by the weather, which had more snow than usual for this time of the year, that people stay home and not spend. It's very hard to tell. So I think we will have to wait and look through the numbers once we have February indicators. For the time being, it does look like we are not quite matching the sort of extremely strong pace of growth that we had in the second half of last year, and perhaps we're heading towards a slower pace of growth. That's certainly necessary and something the Fed will want to see before it gets comfortable to cut rates.
Well, Sandra, the other thing that folks are worried about in the U.S., Menace and I have had a lot of people come on this program over the past 2 weeks and say we are not worried enough about government debt. PIMCO certainly is. They say it's going to look like the 1980s, or it might look like the 1980s again, when you have bond vigilantes demanding more compensation. They write that more deficits are in the cards. The important point is that markets are a disciplining mechanism for governments, keeping them from straying too far down the spending path. Sandra, is that what's in store for us? Are we going to go back to the 1980s where deficits matter and the bond vigilantes are out for blood?
Well, certainly, sitting in the UK, we've certainly experienced the bond vigilantes and their efforts in the past. So certainly, this is not something that can be dismissed and said it only happens in the 1970s and the 80s, etc., the 90s. It has been a very recent experience in the UK. The global trend, though, is that markets have been able to absorb the amount of issuance that has been coming out remarkably well, and only in extreme cases has this discipline had to spring into action. We will see what happens going forward. I think it has been a helpful reminder, perhaps, what we've seen in the UK, that you can't go too far as policy is concerned. We will see to what extent the political game changes, of course, following the US elections in particular, towards the end of this year.
Well, that may well bring a return of term premium. I think if you read that PIMCO article, I would encourage everybody to go and do that. Danny and I have both read through it. It's the reflection of where term premium can go. We peaked into the positive just at the end of last year, but kind of get back to 200 basis points. Is that what the bond market would demand? Sandra, can we just close off with your perspective or the risk? The narrative, if you listen to Mary Daly, if you listen to Waller, if you listen to any of the other Fed speak this week, it is about a hesitancy to act and a reluctance to act to cut too soon. And what one kite that is being flown this morning on the blog on MLive this morning is that you may see the dots change to 2 cuts from 3. What is the risk of that in the upcoming meeting and disclosure?
It's certainly a possibility. I think for the time being, we had the narrative when then the markets thought there would be a lot of cuts. Now it's been scaled back to a lot less. Obviously, the Fed has said, we said all along it wouldn't be quite as many as it priced in, and the markets have swung back into line. But I don't think the pace of growth that we're seeing at the moment needs to slow down, essentially, for the Fed to be able to deliver the rate cuts it had penciled in, to the same extent penciled in. So watch the data and see whether we are getting this growth slowdown. The Fed certainly will be watching too.
Sandra, really appreciate your time this morning. That's Sandra Horsfield of Investec. Okay, Manus, a quick check on your bond market. There's a rally in bonds. Again, despite core PCE coming in a bit stronger, despite euro area data coming in a bit stronger too. I should say the other upset, which we maybe haven't talked about, is S&B's Thomas Jordan surprisingly leaving the bank after a decade, removing the cap on the franc in Jan 2015, overseeing the banking crisis with Credit Suisse's collapse. So, you know, quite the day for central bankers.
Well, we saw what Mr. Hildebrand went on to do when he left the SMB. Very successful career and pundit on Bloomberg TV. The really interesting yield, and I think you hit the nail on the head, is Danny is on. Oh, the boons have disappeared. But there you go. Actually, we asked for the chart, and I think this is the real personification of conundrum, which is not so great CPI data. A little bit hotter, not aggressive, just hotter and out of sync with what the market wanted. And yet there you go, they are buying bonds. Yields are dropping.
I mean, maybe it's because this market is repriced already so much that there's not enough juice left just from this one piece of data.
There's always juice left on Bloomberg, on Bloomberg Brief. We can give you some bonds, we can give you some bonds, and we can give you some non-stretched equity valuations according to Goldman Sachs.
Well, more to come. More juice to come here on Bloomberg Brief.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's Bloomberg Brief. I'm Danny Berger alongside Manish Cranny in New York. Now, it was a rocky 2024 already, and New York Community Bank struggles just seem to continue. It's flagging material weakness in how it tracks risks. It's shaking up its leadership. Oh, and it's also delaying its annual statement. Joining us now is Bloomberg's Charlie Wells. Charlie, I mean, it's just January all over again, it feels. But this time they're saying material weakness in how it tracks loan risks. What's the implication of that?
I mean, look, there's so much concern about commercial real estate right now, right? We've got that $1 trillion of commercial mortgages coming due in the next 2 years, and this just adds to that. It almost feels like there's a wildfire going on, and NYCB has said, oof, we're one of the bigger houses on the block, and we've got some gasoline tanks in the garage. What should we do about that? And I think the really big concern here is that with this concern about lending is that its credit costs stay higher for longer. So let's not forget that NYCB's credit rating was rated to junk by Moody's not that long ago. And so the longer that that continues, the more difficult that this bank is going to find itself in as far as positioning.
I'll give you this, Charlie. You know how to paint a potent image of sort of like the A-team arriving with exploding bombs in regards to bank balance sheet governance. Maybe we'll sort of take the heat out of this one and we'll move. I mean, there's no doubt about it. NYCB, it could be something which is much bigger and rolls out across the country. Talk to me a little bit about B. Riley. I mean, this is an investment bank, and they are stumbling.
Yeah, so this really has been the subject of a short seller narrative that that boutique investment bank does not like. And basically, you know, this is kind of the season of annual reports and why certain financial firms are saying they've got to delay some of their annual reports, why they're late on their homework. And they said that they are looking into some transactions with a key investor. That is Brian Kahn. Now, Brian Kahn has been the subject of a lot of questions by some investors who say that he was responsible for the collapse in 2020 of a hedge fund called Prophecy Asset Management. Now, how he relates back to B. Riley is that B. Riley helped Brian Kahn take the franchise group private. The franchise group is a group of retail businesses with businesses like the Vitamin Shop around the country. Now, the question is that Prophecy Asset Management has been under the subject of a federal investigation, and short sellers have been questioning the value of some of the assets of B. Riley in the franchise group. Now, it's important to note that Brian Kahn says he did nothing wrong, that B. Riley has said that the connection to Prophecy has no connection whatsoever on their financial situation or their assets in the franchise group. But the fact that they had to delay this annual report will unnerve investors because it means that outside auditors have not yet signed off on that report.
Well, there's some other leadership changes, Charlie. I remember in 2017, I went to Malvern, Pennsylvania, where Vanguard is headquarters. And just then, when I was there, they announced that a company veteran, Tim Buckley, would be coming in as CEO. Here we are, some 7 years later, and he is stepping down. Now, Vanguard typically has a very robust sort of succession leadership plan in place. But what happens now with Buckley out?
It's striking. I mean, Vanguard has said that they are going to conduct a wide search. They say that they're going to look, far and wide for the next leadership. But we know Vanguard, right? We know that they have a very unique culture. It goes back to Jack Bogle. It comes to now. And we know that Buckley, had a really great ride. Vanguard pushed into ETFs even more. They pushed into advisory. And according to Eric Balchunas, Bloomberg Intelligence's ETF guru, Buckley helped add $4 trillion to Vanguard's value. And so that is a huge pair of shoes to fill. And what we know about Vanguard is they love maintaining that internal culture. So they are saying they're going to look far and wide. But the sense is that the next candidate will probably come from within.
Okay, Charlie, let's see who takes to the helm. That is Charlie Wells on the finance stories of the day. We're going to track that NYCB stock price for you throughout the morning as we get a little bit more clarity, and let's see how it impacts the broader market in commercial lenders. Now, traders are warning that the breakneck pace of Bitcoin surge may be unsustainable. It's Galaxy Digital's founder and CEO, Mike Novogratz, weighing in on that very topic yesterday on Bloomberg.
This is probably the first time in the history of Bitcoin that we have true price discovery. And what I mean by that is this is the first time that anyone who wants to buy it has easy access to buy it. And so, right, baby boomers have $85 trillion of wealth. Their wealth is, for the most part, managed through registered investment advisors who now, at least half of them or some portion of them can just buy the ETF. And so you're seeing, a step function in new owners of Bitcoin, which is driving, I would say, a frenzy in the whole crypto ecosystem, right? So how crypto always works is Bitcoin gets bought and some people sell a little bit to buy Ethereum and they try to play the catch-ups and the altcoins. And I would say we've gotten to very frothy levels. You can see it in the funding rates of the altcoin market, how much you get paid to actually lend out your coins in Bitcoin, Ethereum, and all the alts. And so you saw it in the equities, the public equity markets, right? MicroStrategy, Marathon, all the kind of public equity bellwethers really went parabolic along with Bitcoin. And so I wouldn't be surprised to see some correction and some consolidation. But I'm very loath to pick a Bitcoin high because I really do believe this is price discovery. Will we test the old high? Most likely. And you'll probably have some consolidation. But I still think we're going to end the year much higher.
It's interesting to hear you kind of come in with some caution in the middle of this euphoria. It begs the question, what's also the new low?
We broke out from 45,000, and so that would probably be what should hold us if there's a real correction. You never know why corrections come. Something happens and people shift mindset, and there's a lot of people that have bought recently. I don't think it'll get there, quite frankly. I think if it corrects, it probably corrects to the mid-50s before taking off to the new high. First the old high, that's 68, 69,000, where we got pretty close. But I do think then you're going to see, and partly this is, if you look at Fidelity or any of these big platforms that have so much baby boomer wealth, just shifting 2 to 3%, 1 to 3% of those assets, encouraging their customers to shift to Bitcoin over time, which has been an amazing diversifier, is a monster number.
That was Galaxy Digital's Mike Novogratz. I mean, he's still a bull, maybe a more cautious bull, saying it could correct first.
It's the first time I've heard him come on where he's not like sort of full euphoria.
Yeah.
We're going to get to 100. We're going to get higher than that. What he is he's saying we're in this price discovery mode. We have, as what's known, this halving event coming up a little bit later on in the year, which is going to be 50% less Bitcoin mined. But, of course, he says it can come back to around $50,000 in this discovery process. So be careful.
I love how he puts it, like an army of salespeople out there saying, look, we have these new flashy products. Come on in. It's a whole new type of people who have access to Bitcoin now.
Now, of course, they're not flashy at Bank of America Merrill's or Wells Fargo when it comes to wealth management. They are about protecting your wealth, but they're about to offer you ETFs. What more do you want?
Maybe Bitcoin a little bit higher. It's nearly $42,000 this morning, up 0.8%. All right, we'll have the things for you to watch out for today coming up in just a moment here on Bloomberg Brief.
Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal.
That deal. The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
It's Friday, and it's Bloomberg Brief. Danny Berger and Manus Cranny in New York. Let's get you set up for your trading day on this Friday. 9 a.m. Eastern, Swiss National Bank President Thomas Jordan briefs the press on his plan to step down in September. Surprise decision. 10 a.m., more U.S. eco data. UMich sentiment and ISM manufacturing comes up. Plus, more Fed speak to end the week. Christopher Waller, Lori Logan, and Mary Daly, yet again, Manus, giving remarks.
Yeah, Mary Daly, very confident about the U.S. economy, not under pressure. Quick snapshot of what's going on. I love this story. I love the Dell story. Record on the price, strong demand, AI servers, and then you have Hewlett-Packard on the other side of this trade, cutting their full-year forecast for the network. They're going to see a slowdown, but this is going to be the driver of risk, NYCB. It just flags, it flags weakness internally for them, Danny, but what are the ramifications? What's the ripple effect?
You can't help but wonder if maybe potentially some of the reason that bonds are rallying and stocks are falling is because of that this is a time you go look for safety, because here we are, redux of the regional banking woes, and do you run to shelter because of that?
Well, not everybody, but a lot of people have come on these shows across Bloomberg and said idiosyncratic, contained. Regional banks don't have a material systemic impact on the U.S. economy.
Having an impact on my small caps, though, down significantly this morning.
We didn't break anything, but we'll leave that with surveillance.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on
that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great
question. That's a question I get all night.
Bloomberg, top experts, great questions.
To me, the overall story is still the same, which is we have a period of disinflation in front of us.
Inflation falling to target is currently underappreciated by markets.
Stocks have been relatively resilient in the face of the fact that data is consistent with stickier inflation.
There's really kind of an everything is awesome mentality permeating the market right now on hopes of this not only soft landing, but no landing.
Investors have been really underinvested, and now they're kind of holding their nose and having to play catch up.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Your equity market on the S&P 500 lower by 0.2%, kicking off the month of March with NYCB Kitchen Sink Volume 2. That stock is negative. It is down hard. We are plunging 29%. These are the issues, Bramo. Discovering material weakness, writing down the value of companies it acquired, and replacing leadership over at NYCB.
The kitchen sink for the first time was about loan loss reserves, and a lot of people were saying this is only because it crossed the $100 billion threshold of assets and had to withhold much more. This raises questions of whether it goes deeper than that, which to me is more concerning and maybe speaks to something broader about the risks of rates remaining higher for longer.
All the things you don't want to hear from a bank. Here's the quote, related to internal loan review, Anne-Marie, resulting from ineffective oversight, risk assessment, and monitoring activities.
Yeah, this is concerning because everyone has come out and was talking about this is idiosyncratic just to this bank and not to other banks dealing with commercial real estate. Lisa, you bring up the point that potentially this shows that this goes deeper. You have to think Jay Powell is going to be on the Hill next week, Jonathan, talking to House members, talking to senators. He's going to get asked about what is going on in the banking industry and if there are wider concerns.
The word you used, I think you're going to hear a lot this morning, idiosyncratic. Let's go through it. NYCB's largest real estate exposure comes from about $37 billion in apartment loans. And here's the important piece, with almost half backed by rent-regulated complexes. That's the big issue for this name.
There is a very specific issue in New York State, New York City in particular, about how much people can charge for rent and then what that does to certain valuations, especially at a time where so many of the apartments are held by that. I will just say, taking a step back, right now, the markets don't care. They care about NYCB. They care about nothing else because right now you're seeing new record highs, and this kind of thing is really being shrugged off to the extent that a year ago people would have said, oh my God, the sky is falling. We better just hunker down and get rid of risk. You're not seeing that in the same way, and that tells you a very big message.
And not just new record highs in the equity market more broadly, by the way. JP Morgan closing yesterday at another all-time high. You take the month of February. This has been an issue for us since the end of January with this individual name. Regional bank index down about 3% last month. No drama there. We've seen much bigger moves than that. S&P 500 banks up close to 4% in the month of February.
At this point, people are looking for the bottom. They're not looking for another risk, another shoe to fall. And this is sort of the question that I have. Have we basically worried ourselves out? And now we don't have any worries left. And so people are just sort of throwing in the towel and saying, fine, I'll go with it. I'll buy. We'll have another net record high on the NASDAQ for the first time since 2021. Okay. Are we getting to that point?
I have no doubt you'll find something to worry about in the next 60 seconds or so. And I'm sure you do. You have a list to work through for the next 3 hours or so. Equities right now on the S&P 500 look like this on the S&P. We are slightly negative. We're down by 0.14% on the S&P 500. NYCB getting hammered, down 29%. Yield to lower by 2 basis points. The 10-year 422.48 in foreign exchange. Eurozone CPI. Upside surprise, not the right kind of upside surprise. 108.13 on euro dollar. That currency pair positive by about 0.1%. Coming up this hour, Steve Weidiger Citi as March kicks off with US stocks at all-time highs. Chris Marinock of Janney Montgomery Scott as New York Community Bank plunges on newfound weakness. And Greg Valliere of AGF Investments as Biden and Trump offer 2 very different visions on the southern border. We begin with our top story this hour, leaving behind a February full of tech-fueled stock market records. Steve Weidiger Citi expecting the broader market to close the gap on big tech, saying this: the extreme divergence of large cap tech profits from other industries should diminish this year and next. We would not be surprised if Mag 7 EPS gains in 2024 were cut in half on strong investment spending and greater competition. Steve joins us now. And Steve, that's a lot to get through. Can we build on that just a little bit more? Where you're expecting some of that gap to close?
If cut in half means 20 to 25% EPS gains, that's still substantial growth. You know, industries that are literally booming, and there's probably a very limited number that are doing that. Booms you worry about on the other side of those sorts of things. But they're not going from large gains to declines. They're going to a bit of a slowdown. And, you know, again, look at Mag 7. There's probably 4 companies that are buying up every microchip that they possibly can to offer AI services. Now, there's an open question as to whether these services, again, are going to find demand in the economy from just about everywhere, that they're not going to compete with each other, and they're really going to all be able to boom together, or will they compete and they will narrow down profits? I think, again, we're not willing to give up diversification in portfolios, right, to just bet on that single trend. And so, again, a lot of other good things are happening in the economy. We're raising our economic forecasts, raising S&P EPS forecasts, and seeing industries that have been weak for the last year and a half bottom out and begin a recovery. They won't do as well as Mag 7 in terms of EPS gains, but hey, they're at a very different valuation.
You're clearly not bearish. You're overweight equities, small, mid-caps. Talk to us about the industries you like right now.
Well, again, you can get mid-cap growth companies in the United States for about the same valuation as European shares. Only the U.S. mid-caps have grown at about 11%, and you know, Europe has grown at about 2%. I think we increasingly want to swerve towards healthcare, something that's been out of favor with the exception of GLP drugs. Equipment makers have had a historic growth rate of 9% dividend growth for 3 decades. They're trading 15% off of their highs. And again, a lot of people thinking that we'll never do anything in healthcare except lose weight, which I wish I could.
I will say that a lot of people are working on that. I'm curious about the idea that everyone seems to be shifting to this idea that earnings are coming better than expected. The U.S. economy is stronger than expected. Fiscal keeps on supporting everybody for the foreseeable future. So why is it that cash funds are on pace for another year of record inflows? People are talking about cash is trash. I don't think so. People love their cash funds, and they are plowing more money into them.
So look, the reason why we're not more overweight equities is a great competition from yield. And so we want to participate in that. Our bond portfolios have a little bit below average duration. We expect, again, to earn that longer than the Fed will stay at 5.5%. But this is good competition. And look, we've been bullish for a while. We've seen increasing bullishness. We've seen new shorts being set in the equity market. Everybody is bearish in the bond market and extremely short the bond market. I think that there are some areas which have been so strong that we want to just start to ease back from them. When you've had 80% returns in software, for example, you know, it's just as time again to just start to shift to some of the other areas. But there's room for both stocks and bonds in portfolios right now.
This doesn't sound like a market that's been drained of liquidity. It sounds like an economy that is flush with liquidity. Why has the Fed been so ineffective at draining this market of liquidity?
Well, again, do you have to? Must we have a new recession, you know, again, to stop this rapid inflation? I think we have another troubling inflation report. that's going to come in March for the month of February. It's going to be another reason for everyone to again say, well, wait a second, maybe we're not on this disinflation trend. Maybe we're going to be stuck here with the Fed doing QT and 5.5% funds. That's possible over the short term. But the reality is, the good news has been, we've been able, again, to supply and demand to line up a lot more in a stable way without a massive surge in unemployment. Now, if we get too excited about that, there's going to be some problems.
You've upgraded growth. What do you see? What do you like? What's leading to that?
Well, I think, again, it's weaker pieces of the economy. We've had a hidden recession underneath the surface. If you're looking at Germany, if you're looking at Japan, if you're looking at China, if you're looking at manufacturing in the US, which is nobody would really look at, but the reality is it's contracted for the year behind us. Trade contracted 8% in the year through the third quarter of last year. And these weaker components, again, are moving into a more stable, growing place. Probably not going to be anything V-shaped, but it's those things along with large cap tech with AI, which is in the boom.
There's been a big spread between manufacturing and services for quite a while, as you indicated over the last year, 2 years. Manufacturing started to come up to services. Is that how you expect that story to complete?
But remember, it will come with a very different labor market outcome. Services, labor intensive, manufacturing automated, right? So the headcount differences are going to be really, really substantial. The services industries can't keep adding 200,000 jobs per month just in those industries, right? So you've seen a halving in employment growth from where we were 2 years ago, when services just turned right back on like a light switch. Again, hospitality, airlines, travel, all of these things, incredibly labor intensive, and we had massive job losses there to recover. But now we're at the point where I think it'll slow down. And it didn't in the month of January. It was 353,000 jobs in January, but we saw seasonal distortions in employment, inflation, retail sales, all of these things in different directions. It's going to take a while for the market to sort it out. I think we'll be a little more worried before we start to really come to grips again.
John mentioned your upgrade of U.S. GDP. Mohamed El-Arian recently in Project Syndicate was talking about what happens in the United States matters to the rest of the world, doesn't stay in the United States. Do you foresee then U.S. growth, if you see it picking up, helping the rest of the world?
It is, but it's challenging at the same time because, again, the amount of time that we spent with restrictive monetary policy is still going to be a bit longer. We haven't changed our mid-year estimate, really, but you know, again, confidence that we're going to have easing, the communication of easing through markets, right? We could set that back some. So the dollar has been stronger. Now, that both helps and that hurts. Yields have risen this year, right, at the long end of the curve and across most of the curve. So those are modest challenges, while some of the things are really helping. Consumer demand has not collapsed. And producers have been underwhelming, and they've been really short in terms of meeting demand.
Hey, Steve, it's good to see you. Always great to catch up. Thank you, sir. Steve Wanning there of Citi. Bramo looking for one, maybe more than one, ugly inflation report in the next few months.
That everyone can then just look past, because it's really going to be this ongoing disinflation. I'm really interested in what a lot of people are saying, not just Steve, about it's not going to be an even ride with AI adoption. And I think my favorite story from this week was Teleperformance, which is this French call center. And basically their shares absolutely plunged because Klarna said that basically they could respond to all their calls using AI. And that was wiping out the entire industry of people who would call you up. I mean, these are like the little pockets of distress that I find fascinating in this transition.
Is this on the list of things to worry about?
Yes.
Is this it? French call centers?
Absolutely.
Is that where we're at?
Well, if you think about it, how many businesses like that will be rendered completely obsolete that have not been priced yet for that type of outcome?
The Uber bear on Wall Street is now sort of like holding on to French call centers.
100%.
Bearish thesis.
It's going to be my clarion call.
Bramo, never change. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The BOJ governor is keeping the markets guessing over the timing of the central bank's widely expected rate hike. Kazuo Ueda told reporters at the G20 central bankers meeting in Brazil that the price target is not yet in sight. Now, his comments did appear to pour cold water on the earlier move this month. Economists, though, for their part, are still anticipating a near-term hike in March or April. The last time the BOJ raised rates was 2007. SNB President Thomas Jordan is stepping down. It was a surprise announcement. It's going to happen at the end of September. He had been the Swiss central bank's chief for more than a decade. He steered the economy through the euro area debt crisis. He removed the cap on the franc in 2015 and adopted the world's lowest interest rate. And dealt with that whole banking crisis thing. Don't miss Bloomberg's interview with Thomas Jordan. That's going to be later today. Meta is winding down its news feature in the U.S. and Australia. The company will withdraw support for its Facebook News tab in the countries from April. Publishers with existing agreements with the company will still be able to post content at least until their deals expire. Lawmakers around the world have been pushing for Meta to compensate publishers for content, but Meta says demand for the service has declined. That's your Bloomberg Brief. John.
Danny, thank you. I can't believe it's been a decade on the job for Thomas Jordan. I interviewed him shortly after he got it. It's amazing how quickly time flies, Lisa.
I saw that and I thought, didn't he just get there?
I know.
It's wild.
Ridiculous. I just want to talk about Apple briefly. Removed from the conviction list at Goldman. The stock is down by about 1%. We'll pick up on that later. And next on the program, New York Community Bank shares plunging once again.
500 basis points of rate increase has really stressed the sector. So as we look at the loans that are coming through, we see less loan demand and less that can really hurdle in this environment.
That conversation is coming up next, live from New York City this morning. Good morning.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's a huge week ahead in politics. On March 5th, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, 2 days later, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kaylee Lines, and Bloomberg's top political analysts will bring you live global coverage of both events, starting Tuesday, March 5th. Bloomberg, context changes everything.
Four months of gains on the S&P 500, live from New York City this morning. March 1, we're down about 0.1% on the S&P. Under surveillance this morning, New York Community Bank shares plunging once again.
For investors right now, growth in banks has been kind of tainted with the Silicon Valley failure, Signature failure, as well as First Republic. Those banks grew really quickly. And so as we're out on the road talking to investors, we're doing conferences, they're nervous about growth in banks too quickly. 500 basis points of rate increase has really stressed the sector. So as we look at the loans that are coming through, we see less loan demand and less that can really hurdle in this environment.
It's the latest this morning. New York Community Bank shares plummeting. The company announcing, quote, material weaknesses in its loan review process. The bank quickly swapping CEOs and warning investors it expects to miss a deadline for filing an annual report as it shores up controls. Chris Marinac of Janney Montgomery Scott saying this: director changes are part of the early repairs at NYCB. Investors should be pleased to see swift action given what occurred a month ago. 2 directors have resigned. We see this as a healthy change that should build confidence. Chris, I'm pleased to say, joins us right now. So, Chris, I assume you believe this stock should be up this morning and not down 30%. Is that right?
That is right, or at least trading flat, John. I don't see any reason to be haircutting the stock. Tangible book value only changed by 3 pennies, given the fourth quarter changes filed last night. Very minor.
Why are you so confident there aren't any more monsters underneath the bed at NYCB?
Well, I think the company's issues have to do with stress testing. The company has to stress test for higher interest rates. They're doing that. They increased reserves. I think there's more of that to go, but the company has the earnings to work through this. This is not an earnings issue for the company. The credit issue for the company is stress testing and not having done it sooner. And I think the prior management team, unfortunately, had to go. I think we had to have the change in management to have a confidence change. The largest individual shareholder is Sandro Danello. He's taking charge. He's making very swift changes. You have a few unhappy board members who have left, and that's fine. They should change too. I think this is all healthy to get the company where it needs to go. They're now $115 billion. They have to be part of the new world order that is a regional bank under new guidelines. And yes, the regulatory world is changing quickly, but you have to adapt and you can't sit still.
You said there are a couple of unhappy board members, and I'm glad you brought that up because that raised a red flag in my view. The director of the board, Hanif Daya, resigned, and in the resignation letter, he said that he didn't support Sandra Danello's appointment to CEO. Why?
He's been with the bank since 2007. I think he did not want to see the CEO change. I think he decided to vote with Tom Cangemi. That's his prerogative. I think you're going to see the company move forward with another director and frankly continue to make the changes very quickly. You have one quarterback at the company. You can't have 2. So you have to take QB number 1 and run with him and make these changes and move forward. I think the story is really going to transition to recognizing credit risk and frankly fast-tracking a lot of the changes to diversify the portfolio. They've had too many multifamily loans and too much real estate. They'll change that. They'll be a much more balanced company, and frankly, they'll make more money, which will create book value growth, which will get the stock price moving again. That's what investors are overlooking, but that's a short-term reaction. I think that will change.
The vast majority of people who are waking up right now in markets probably don't care about New York Community Bank Corp in terms of that particular company, but they do care if this is a harbinger of more weakness to come. If this means that yields remaining higher for longer is creating some real cracks on the balance sheets of banks that have already been punished but can't seem to climb out of it. How would you argue that this is truly idiosyncratic when this is not just a regulatory capital issue?
So every bank has credit risk, and I think if you look at the 10K filings we've seen this week and last week, we are seeing increases in the criticized assets. Not as much non-accrual and non-performing, but really criticized. Again, back to the stress testing issue. Banks are recognizing the risk. I think what investors don't see is that leverage is 60% today instead of 95% in 2008 and 9. It's a material difference. So you're not going to lose money at New York Community like you would have 15 years ago because leverage was much higher. You'll have some losses. You'll have some need to build reserves. They've done a big piece of that already. I think the whole industry is going to continue to march forward and be a lot more profitable than folks understand. The other point I'd make is that most banks are asset sensitive, which means that higher interest rates for longer actually benefits than interest margin. You'll see in most 10Ks that companies actually see an increase to earnings if interest rates are high. So in a lot of respects, the Fed cutting rates too quickly is not a great thing for the industry. I think it is a perception issue we have to overcome.
I have to wonder, though, when this thesis comes true, right? Because right now we're looking at, yes, higher yields, but an inverted yield curve, which makes it really challenging, as we heard from Hope Dmchowski. We also are seeing some real concerns about loans that are not getting liquidated because there just isn't a market for them. When does the page change for banks that otherwise are pretty challenged when it comes to profitability right now?
I think the banks are in much better shape than folks realize. I actually think there's enormous liquidity out there, whether it's private credit, other investors, other banks who will buy the loans. I actually think it's much better than perceived. The challenge banks have on either selling loans or liquidating other assets is that they don't want to take big haircuts today. They'd like to let time pass and work that through. Sometimes they're able to do that. That's where reserves and capital come in. Other times they have to take action. I think in NYCB's case, you're going to see them continue to take action very swiftly. We've seen it with the changes here. I think the 10K delay will be resolved within 14 days. A lot of that are changes that have to happen under GAAP accounting. And honestly, we've seen other banks with internal controls that are large companies like JP Morgan and Wells Fargo. They've made their changes and moved forward.
A year ago, SVB's collapse, ultimately, the underlying issue was also higher interest rates. You're talking about the New York Community Bank, poor stress testing on higher interest rates. Who else is having poor stress testing issues right now? What other banks when it comes to high interest rates? Or should we just expect this to happen every few months?
Well, I think NYCB is unique in terms of having crossed over $100 billion with an FDIC transaction, not being fully prepared to do the stress testing this year. That, I think, is idiosyncratic. I think the rest of the industry is all over this. I think what you're going to see is that the SVB issue was about poor liquidity management, top-heavy securities that were underwater, and then, frankly, deposits that were out of whack because they had large venture capital deposits that all ran. Those big concentrated deposits are all gone because they largely were at SVB, First Republic, and its Signature. So the industry is in much better position from an uninsured deposit standpoint. And NYCB has had excellent deposit flows through the past month. That's really what investors should focus on. The deposits have been stable. The company's going to make money this quarter. It's just unfortunate that they have to make these management and board changes now. But again, it's going to be for the long run much better to do this house cleaning today.
Chris, outside of NYCB, isn't the market coming your way? Based on the fact we got JP Morgan yesterday closing at an all-time high, pretty decent month of gains for the banking index on the S&P 500 last month. Looking at the smaller banks, the regional banks, yes, a little bit lower through February, but nothing drastic given the challenges of this single name. Is the market coming your way?
I think so, John, and I think you're going to find the tangible book continues to grow for the companies this quarter. We have headwinds out there from higher interest rates. We'll probably see mark-to-markets go up again on higher rates at the end of March, but we can handle that. Most banks are managing expenses really well, and at the end of the day, the net charge-offs that companies are reporting are very modest. That's what's ironic about this. We're worried about stress testing, but we're ignoring the fact that net charge-offs have remained very low.
Nothing to see here. Chris Marinac of Janney Montgomery Scott. My words, not yours. I know, Chris. Ultimately making the point here, Bramo, that we shouldn't be down 30% if this is truly that kitchen sink cathartic moment for this name.
The second one. Again, I mean, I guess that's part of the problem is that they've had this before. It was a kitchen sink moment the first time. Typically, when you've kitchen sinked something, there isn't stuff left to kitchen sink again. So the question is, what's left? And then there's also clearly still nervousness about what we don't know in certain banks, some of the risks that we haven't fully priced, and that's evident in one name, not the rest.
I don't think we want kitchen sink volume 3 anytime soon. Coming up on this program, President Biden, Donald Trump offering two very different visions on the southern border. We'll be catching up with Greg Valliere of AGF Investments on immigration and the election. That conversation just around the corner from New York City this morning. Good morning. Equity futures on the S&P 500 down just 0.1%.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
4 months of gains on the S&P 500, heading towards just about a second consecutive week of gains as well on the S&P and the NASDAQ. We are basically unchanged. The NASDAQ going nowhere. On the S&P 500, down around about 0.1%. Yesterday, PCE basically comes out in line. In line is the new beat for inflation in the bond market. It meant yields came back lower, down from the highs of the year on a 2-year. We're down to about 459. We were through 470 earlier this week. 459.35 on a 2-year, Lisa, down 2 basis points.
It's taking off a tail risk. Essentially, things to worry about. The list got a little shorter, at least for the moment. Basically, people thought maybe we would see an upside surprise to inflation, and then we could be worried about sticky inflation and runaway, a sense of an economy where you don't get the immaculate disinflation everyone was hoping for. Then it came in line, that tail risk taken off the table, back to the races.
Quite a turnaround for the bond market. Let's talk about a turnaround for dollar yen as well. Switch at the board and get to foreign exchange. Dollar yen, first close sub 150 in about 2 weeks. In fact, I think precisely 2 weeks. 150.45, back above it this morning by 1/3%. So we have a weaker Japanese yen. Here's the latest commentary from the BOJ. Bramo, work with me. We are not yet in a position to foresee the achievement of a sustainable and stable inflation target. The governor, Ueda, basically pouring freezing cold water over any kind of imminent rate hike from the BOJ.
Someone who isn't familiar with the story and hears that is thinking, I don't hear anything but blah, 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 blah. This is how the Bank of Japan communicates, right? On one hand, we might be getting closer to some sort of level that the Bank of Japan was looking for yesterday or 2 days ago, and then Ueda coming in saying, not yet, and this is enough to cold pour water. This is the reason why we're not seeing massive moves, more than just sort of incremental around 150.
This is a policy effort that is decades in the making, not years, decades. Whaley of BlackRock talked about this yesterday.
Yes.
You have to remember that. They're not going to move like Chairman Powell's going to do a news conference and say, let's go.
Right.
You're going to get a surprise at some point from the BOJ, but at the moment they're not willing to surprise us based on this communication.
I'm old enough to remember when we thought that this was one of the tail risks. This was on the list of worries that they would
no longer on the list?
I don't think it is. I think that we can remove a sudden move from the Bank of Japan from the list of potential worries because they have shown time and again that they are in no rush.
You can clip that. You can sort of clip that, maybe play it out later this year. We will see if that should have been on the list. Dollar yen right now, 150.43. We're positive 1/3%. Under surveillance this morning, our top stories: China's factory activity shrinking for the 5th straight month. Another sign of weakness in the world's second largest economy. The country also seeing a continued slump in its housing market. The value of new home sales from the 100 biggest real estate companies sliding 60% from a year ago. 60%. February sales were down nearly 21% from January. Those numbers, Bramo, ugly.
Especially because a lot of people seem to be coming on the show and getting slightly bullish, at least as a trade, on Chinese equities. I will note this. Michael Hartnett from Bank of America saying that Chinese stock funds saw their largest weekly outflow in the past week, since October. So maybe people who are viewing it as a trade see it as sort of reaching the end at a time where the data really isn't turning around that much.
Speaking of a trade, the market was up 9% in February. That's quite a squeeze. That's quite a run.
Squeeze is the right word. It's not as if people are just,
squeeze.
Yeah, this isn't people running into that nation's stock market and saying, let's go. This is people saying, how bad can it possibly get? And that seems to be where that is sort of fluctuating at a time where you're seeing people maybe close out that trade.
Hasn't had that warm, cozy, friendly feeling for international investors over the last 12 months, that's for sure. Let's turn to the central bank speak. Fed Presidents Williams, Daly, Mester and Bostic saying cuts will come once the data improves. San Francisco Fed President Mary Daly telling Bloomberg, quote, there's no imminent risk to the economy. March is a busy month for central banks. We've got the Bank of Japan's Ueda telling reporters yesterday that a stable inflation target might not be in sight. The comments weighing on bets the BOJ will hike on the 19th. The ECB is going to decide next week on the 7th. Then the Fed decides on March 20th. Okay, let's spin the wheel. Which one do you like? Out of the three, which one are you focused on? ECB, BOJ, Federal Reserve?
I would say actually more ECB. The Federal Reserve, we hear a lot from. I'm not really searching for indications of where their minds are at right now, but the ECB, I think, has a more difficult nut to crack, given the fact that their inflation read came in hotter than expected this morning, and it's completely modeled country to country. They have a different kind of mandate than in the United States, where there is one nation, albeit fractured. You have a lot of different nations with different economic profiles and different inflation outlooks, and that, I think, is much more challenging at a time where they're also facing weakness.
The growth profile is drastically different, Europe versus the United States, and has been for a while. Callum Pickering, by the way, of Berenberg, is going to join us shortly on that story. Here's your next story. President Joe Biden and Donald Trump clashing on the southern border.
This is a Joe Biden invasion. This is a Biden invasion. 3 years ago, we had the most secure border in history. We had the most secure border, and people weren't coming because they knew they weren't going to get in.
So here's what I would say to Mr. Trump. Instead of playing politics with this issue, instead of telling members of Congress to block this legislation, join me, or I'll join you, in telling the Congress to pass this bipartisan border security bill.
President Biden challenging Trump to make progress on immigration after helping to sink a deal in Congress as work on Capitol Hill stalls. The Biden administration is still mulling an executive order on the issue. Greg Verdier of AGF Investments joins us now for more. Greg, that's the rhetoric, the talk, the politics. Let's talk about the policy. What kind of policy change are you expecting sometime soon?
Probably none. I think it's unlikely that we can get Biden and Trump together on this issue. There still is a desperate need to aid Ukraine, and that is a driver for many people on Capitol Hill. So I'd say maybe there's a 1 in 4 chance we get an immigration revival of legislation along with a Ukraine deal, but the odds are below 50%.
Well, Greg, what about an executive order then? Will Biden be pushed into trying to do something before the election?
Yes, he needs to do something. I think this perception by the public that Biden doesn't have a plan, that he got caught off guard, it has hurt him badly. And if Biden loses the election, I would argue he may lose because of immigration more than any other issue. So you're right, he has to do something. I wouldn't rule out an executive order fairly soon.
Our polling data yesterday showed that swing state voters mostly blame Biden, but we are seeing a little bit of an uptick of individuals blaming Republicans as well, those in Congress and the Trump administration. Do you think Biden is able to turn this around the way, say, Tom Suozzi did and push it to Republicans for not willing to meet him on a deal?
Well, he'll try, and I'm old enough, I don't remember Harry Truman, but I've read a lot about Harry Truman, who won a surprise re-election based on fighting against a do-nothing Congress. And if you see Joe Biden say it's a do-nothing Congress day after day after day, it might sink in.
Can you set the record straight, Greg? What can Biden do single-handedly versus does he need congressional sign-off in terms of some sort of presidential order to take care of something on the border?
There's not much, and there's not much he can do for Ukraine, sadly, or Israel, or Taiwan. Those are gridlocked. I do think there's going to be a budget bill. Finally, this long, torturous, dysfunctional fight may come to a close because April 30th is crucial. That would require still a new extension. But on April 30th, if there's no deal, we have automatic across-the-board spending cuts, and I think nobody wants that. Certainly no Democrats want that.
Although it seems like people kind of expected this sort of kicking the can down the road that we got, and we're not going to get some sort of government shutdown. Does it give you any hope that we're going to keep kicking the can down the road, which I guess is the best case outcome that we can have right now in Washington, D.C.?
It's the best case. We'll kick the can probably again. We have new deadlines of March 8th and March 22nd. I think they'll be kicked down the road. You know, if we get into the summer, they may just say, the hell with it. We'll just do a bill for the rest of the fiscal year. That could actually happen, and they'll start all over again on October 1.
Greg, let's talk about money. Biden's got a lot of problems. Money ain't one. And I'm not talking about the beach house in Delaware. I'm talking about campaign fundraising. Right. Bloomberg's Bill Allison reporting groups allied with Biden have already committed to spending more than $700 million to help him beat Donald Trump in the 2024 election. How important is that going to be?
It's huge. It's a sleeper issue, John. Biden was out in California a few days ago raising more money, so there'll be no shortage of funds at all. At some point, money loses some of its clout, but I think that right now the financial advantage for Biden is significant. It's one of many reasons why it is way too early to count him out.
When you look at the other side, the Trump money, a lot of issues there because he's using campaign donations to pay for his legal bills. What kind of cash strap is he going to be in come this summer?
You would think it would be considerable. Nikki Haley has fired away aggressively on this issue without many results. But no, I would say by summer, the legal nightmare for Trump is going to be draining finances by quite a bit. It's a big issue.
Just to follow up and sort of switch gears and end on something, one of my other worries, this is one of my top worries right now, which is what PIMCO is talking about, the deficit, the fact that we are facing off with both candidates not willing to cut the deficit. We talk about this ad nauseum. Everyone's like, all right, we know this. But there is this feeling that there has to be a higher premium, term premium in the yield space to really offset the risk that seems to be evident to everybody. And they say it's starting to take hold. How much does the bond market have to sell off before Washington takes notice?
It's a great question. You talk to people on Capitol Hill, and they really don't want to address it. They can't figure out what the prescriptions might be in terms of spending cuts or tax increases. We had in the year that ended on September 30 a deficit of like $1.8 trillion with a good economy. I mean, God forbid the economy should be softer and raised higher. It could go even higher than that. And yet I don't sense any kind of urgency on Capitol Hill.
Hey, Greg, I'm not sure when you'll get some. Greg Valliere of AGF Investments. That will come down to whether this bond market actually sells off in the fashion that would require some action. That's where the pressure needs to come from, Bramo. Haven't seen it yet.
We saw a PIMCO paper, though, yesterday on this point, and there are lots of papers being written on it. We're not necessarily seeing the bond vigilante movement, but they're basically saying that this could lead to a higher structural term premium. Basically, yields are going to remain higher regardless of inflation on the longer-term treasuries, and this could affect everything in the space that everyone's buying into right now. Again, this has basically been the person who cries wolf time and time again. Has something shifted? And everyone who I talk to says, maybe, you know, and then other people say, but it's the yield.
You've made me smile so much in the last 40 minutes. How long is this list? And is European chocolate on it? That's what we want to know.
100%. It actually is.
Chocolate's on the list?
Yes.
Okay.
Well, it's also the policies behind it, just not because I agree or disagree, but just it raises a new specter of risk in fiscal policy and tariffs. I think are important also. That's also a tail risk.
I was trying to work out the chocolate fiscal policy connection. But I understand the tariffs and all of that stuff.
Yeah. I mean, I also, you know, chocolate's important. And if you start having less chocolate in Mars bars and things of that nature.
Shrinkflation.
True. I mean, well, it's not just shrinkflation, but quality inflation. You know,
is the president actually going to talk about this in the State of the Union next week? Is he actually going to talk about this shrinkflation
Political
stuff?
reported that he's going to spend some time, or they're debating how much time they should spend on shrinkflation. My guess is they think it's landing. The issue is, when the president talks about shrinkflation, he's just hammering home the issue that consumers have right now, which is it reminds them that, yeah, there is inflation, and it wasn't here prior.
This issue has been around for decades. We've been talking about this for ages. Why all of a sudden are we jumping on this bandwagon? This has been an issue forever.
I mean, I guess because certain things weren't sticking, so let's try this one. I mean, how many times?
Throw it at the wall.
I mean, honestly, when you get a box of cereal, and I know you don't do cereal all the time, but I will say when you used to get a box of cereal.
Cattle feed for humans. You know my view on it.
So if you get it, it's like, you know, a quarter filled, and then they say, well, they just want more space to kind of cushion it, but it's, you know, filled less and less.
But to your point, companies have been doing this for decades. They have to, this is capitalism. If their input costs are higher, they have to figure out a way to either raise costs or put less in so they can also make money.
Equity futures right now negative about 0.1% on the S&P. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Russian opposition leader Alexei Navalny will be buried today in Moscow amid heavy police presence. Riot police have been deployed near the church, and metal barriers were erected on the streets ahead of the funeral service. Navalny died on February 16th after falling ill in a remote Arctic maximum security prison. Dell heading for its biggest gain in 6 months, up some 23%, and reported fourth quarter results that beat expectations. Analysts say demand for AI servers is driving the momentum. The stock has more than doubled over the last 12 months. Elon Musk is suing OpenAI and its CEO Sam Altman, alleging they have breached the AI startup's founding agreement by putting profit ahead of benefiting humanity. The 52-year-old billionaire says the company's close relationship with Microsoft and the makeup of its new board undermines its original mission, that being of creating open source technology that wouldn't be subject to corporate priorities. Musk was one of the early funders of OpenAI. And that is your Bloomberg Brief. John.
Danny, thank you. Up next on the program, the Fed in no rush to cut.
Eventually, I do expect us to cut interest rates later this year.
We are ready to make moves and adjust as the data demand us to do.
It'll probably be appropriate to see us to start to reduce rates in the summertime.
That conversation coming up next, live from New York City. This is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. Next week, Bloomberg brings you the latest from China's annual National People's Congress, including China's budget plans, economic outlook, and geopolitical tensions. Coverage begins next week on Bloomberg. Context changes everything.
Equities on the S&P 500 negative here, but recovering. We're off session lows. We're down here by about 0.07%. Under surveillance this morning, the Fed in no rush to cut rates.
Eventually, I do expect us to cut interest rates later this year, but really right now, there's not a sense of urgency to do that.
We want to avoid holding on all the way to 2%. We are ready to make moves and adjust as the data demand us to do.
It'll probably be appropriate if things go the way I expect to see us to start to reduce rates in the summertime.
Here's the latest this morning. Fed speakers waiting on the data, continuing to push back cuts until later this year. PCE inflation data rising in January at the fastest pace in nearly a year. The latest US payrolls report due a week from today. Bloomberg's Callum Pickering sees the Fed cutting 4 times this year, starting in June, with the economy heading for a slower down rather than a landing. Callum Pickering, Berenberg's senior economist, joins us now. Not Bloomberg's. I'm just used to seeing that B and reading Bloomberg. Berenberg's Callum Pickering joins us now. How are you, sir?
I'm good, thank you. It's good to be in New York.
Good to see you. So the good news is that we didn't get bad news yesterday. Is that right?
Yes, more evidence that the US economy is just sort of humming along nicely, may slow a little bit in the first half of the year, but yeah, it looks like it won't land, but just slow down, which is a good outcome.
We've seen a really synchronized hiking story from the Federal Reserve and the ECB. How synchronized do you think the cuts are going to be?
Let's see. I think the risk is that the Fed goes less rather than more. I mean, I remember last year we were discussing what this whole question around the inverted yield curve but no recession actually means. And we just got to ask at this stage, so which price is wrong? Is it the 10-year or is it the short end? Okay, the short end maybe is 50 or 100 basis points too high, but you still need a little bit more on the long end. It's entirely possible that we're just adjusting here to a higher growth, slightly higher inflation environment. We've completely left the low interest rate world, and we're just having a little bit of a problem here, and central banks are having it too, just understanding what's the normal rate of growth for real GDP, where will inflation settle at, and what interest rate will you need just to balance the economy. And all of the upside risks in the US that we would have been hoping for last year seem to be playing out on employment growth, on productivity growth, on demand. The government's getting away with a lot of good fiscal stimulus. It's a nice story at the moment for the US.
All right, let's sit on that. Good fiscal stimulus. I keep thinking about how much money is kind of going into this market as there seems to be endless liquidity. What is the US doing that Europe is not, that's making it flush with cash and that's supporting growth?
Okay, first question is, what can the US do that no one else can do, which is run a 7% deficit because it has the reserve currency of the world. But then you say, what do you spend that deficit on? 10% rise year over year in investment growth. Fiscal policy in the US is tuned towards boosting the net assets of the country, boosting supply, and adding to long-run growth potential. The major fiscal acts are not simply just knocking down old coal-fired power stations and building new, yes, greener, that don't produce more electricity, but just add to the debt. You're adding to productive capacity right at the time when you have, well, a normalization in demand growth because you've fixed most of the GFC problems.
So are you making the argument that we could see this growth and this flush of liquidity from fiscal without any kind of inflationary surge?
The US seems to be matching demand and supply better than any country at the moment, certainly better than in Europe because we're much more exposed to the global supply shocks. But whilst we have the hope that this can continue, strong growth at acceptable inflation without the need to cut much. Look, if the Fed only goes 2 or 3 times this year because US growth surprises the upside, that means bond market volatility, but net as an economist, of course, I'm happy about that. The risk for me is what happens next year. We are running an economy very, very close to balance between the supply and demand, but we're matching, so that's okay.